It's time for Jim and Stop Trading.
Story this weekend, Bloomberg, about Starbucks having some good numbers so far with the pumpkin spice latte. I've confirmed that that's true. And there are many things that are going well there. They've got some good numbers. Now, is the stock going to go up on this? Well, this is, again, as an example. File these things away. You've got some good numbers coming from Starbucks, record numbers. You have things that are starting to work for Brian Nickel in the U.S. You do have many buyers in China if he does want to sell it. So, I mean, yeah, go sell this. My problem is, when do you know to get it back? And that's one. Look, I can make the same case for when do you get back into Lam Research, which is a really good company. When do you get back into NVIDIA? But I think in the end, you're going to want to buy growth. You're always going to buy growth. It's always worked. And I think people seem to forget, and they want to gravitate toward General Mills. Unless General Mills wants to combine with Kraft Heinz, you don't have anything other than a 5%.
You're saying there's no room for value at all? I mean, what about dividend yield? No?
I don't like value.
Yeah.
No, I think that growth is working well here. It has periods where it underperforms, and those are periods where you buy it. It's been traditional since 1984. Not going to change now. If I have to do value, I have to figure out, well, what would Kraft Heinz do if it could buy Campbell's, and how much of a premium would that be? And the answer is, I don't know how much premium you can have to be able to make this so these things work.
Right.
These are brands. Let's watch PepsiCo, because they've got really fine brands. Maybe something can happen there, but in all, I'd still rather buy an Apple. I'd rather buy a Corning, which is up and
upgraded today.
Now, I think Corning is a terrific situation. They've got the glass that. Talk about the ability to have the supply chain.
Yeah, no, Apple's got an event a week from today. Tonight, Signet.
Tonight is Signet. This is the jewelry company that's having good numbers, being brought down, I think, overall by the market, because they're having pretty good same-store sales, and they represent some value. Look, when you want to watch value, watch the Ross stores, watch the TJX. Those represent where people go and say, you know what, I'm still doing well. I have a belt today, Perry Ellis. Now, I asked my wife, who's Perry Ellis? She goes, Jim, that's someone from 1973.
Yes.
Good luck for you. I said, well, the belt's...
He had a moment.
He had a moment, but all I can tell you is that who can tell, other than if you're close, that it's plastic and not leather.
Jim, we'll see you tonight. Busy week ahead.
Thank you, Carl.
Mad Money, 6 p.m. Eastern Time. Little nibbling here, back above 6,400. Stay with us.
is all about.
Good Tuesday morning. Welcome back to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla. We are live, as always, from Post 9 of the New York Stock Exchange. David Faber has the morning off. It's the first trading day of September, and markets are starting under pressure here. The S&P down almost a full percent. Every sector except for energy is red. Technology is at the bottom of the barrel today. You've got information technology, industrials, and financials, as well as communication services, all down about 1%. As far as industry performance, again, energy is holding up a little bit better. We're less than 2%, though, away from record highs on the S&P 500. NASDAQ pulls back a little bit harder. Some exceptions today, like a PepsiCo, which we'll talk about, getting an activist stake from Elliott. As far as treasuries kicking off the week, take a look. We have some selling with yields a little bit higher across the board. The 2-year 3.645, the 10-year yield 4.269%. Today, former Fed Governor Alan Blinder will join us ahead of this week's key jobs report. What's at stake for the Fed's interest rate decision and his first comments on the future of Lisa Cook. The market still awaits a ruling there. And then the future of President Trump's tariffs after an appeals court rules against him. We are live at the White House with the latest developments. Plus, as mentioned, Pepsi shares bucking the sell-off, rallying on news of a new activist stake from Elliott. What could happen next for the company?
Let's get some ISMs and construction spending with Rick Santelli. Hi again, Rick.
Hi, yes, these are the ISM manufacturing. We hit S&P about 15 minutes ago. This is an August read. There was no mid-month read. For the headline number, 48.7, which means we have 6 consecutive readings now below 50, which is contraction territory. But 48.7 is actually the best number since June when it was 49, still below 50. If we look at prices paid, there's some good news here. 63.7. 63.7 would be the smallest prices paid number since Feb of this year. That's a good thing. Prices paid going down take some of the inflationary pressures off of many products. If we look at new orders, 51.4. This is the only number above 50. 51.4 takes us back to where we were in January. That's the comp 55.1. And by the way, that was the last time it was over 50. So we've reached once again on new orders back above that expansion mode. On the employment front on this very important week, we're going to get 2 employment reports. Comes in at 43.8. 43.8 would be comping to the weakest level since 43.4 just last month. So we see that we are not doing very well. This is 7 consecutive employment component that is in contraction territory, meaning under 50. Construction spending always 2 months in arrears. This July number comes in at -110, pretty much exactly as expected. And how does that comp? That actually be the best number since April when it was positive at positive 0.1%. Interest rates from 2s to 30s are all higher, but well off their highest levels of the session as global longer-term rates continue to be sticky to the upside. Sarah, back to you.
Great. Thank you, Rick Santelli, especially highlighting that lower prices paid. Important as we wonder whether to worry about inflation. There's going to be a lot. It's a holiday shortened trading week, but there's going to be a lot of economic reports to watch. As Rick mentioned, we'll get JOLTS tomorrow, always important job openings data, the Beige Book, which we know the Fed pays attention to, anecdotes from around the country on the economy. ADP is private sector jobs Thursday, and then Friday is the big August jobs report. We know since the Fed chair gave that speech in Jackson Hole, they're leaning at least toward September rate cut. Will the jobs number really strong change that narrative or that viewpoint? I think that's going to be a key question. We're also getting more color around the consumer. We heard, for instance, from the McDonald's CEO this morning on Squawk Box. Listen to what he said.
If you're upper income, earning over $100,000, things are good. Stock markets are near all-time highs. You're feeling, quite confident about things. You're seeing international travel. All those barometers of upper income consumers are doing quite well. What we see with middle and lower income consumers is actually a different story. It's that consumers under a lot of pressure in our industry. Traffic for lower income consumers is down double digits. And it's because people are either choosing to skip a meal. So we're seeing breakfast. People are actually skipping breakfast, or they're choosing to just eat at home.
There's that bifurcated consumer again. Pressure on the low income, high income's doing okay, tied to the stock market and income growth. That's definitely been a common refrain this earnings season. While overall consumers holding up relatively well, there's a split, of course, across the spectrum.
Yeah, a lot of work over the weekend about real consumption. We got some GDP revisions last week. It's running about less than half of the 2024 pace. That's consumption adjusted for inflation. But obviously, we're watching. I think there's elements of even the Secretary of the Treasury has said if you don't have assets, it's a time of pressure to some degree. Right now.
And also they're looking a lot at the housing market, potentially what they can do there. We also heard from Signet on earnings this morning, and they saw growth in same-store sales. This is the big jewelry company. Good quarter from the call. We see our customer willing to spend as long as the assortment is compelling and delivers on their expectations of value. There's that value word again. It's very frequent this earnings season. We believe our assortment is well positioned to deliver against that backdrop. I think lab-grown diamonds are a big driver in general of jewelry right now. And then Constellation, tough if you're in the beer business. Over the last few months, high-end beer rates decelerated sequentially as both trip frequency and spend per ticket declined. Notably, high-end beer buy rate declines for Hispanic consumers were more pronounced. Remember, that's another theme than general market declines, which has an outsized impact on our beer business compared to the broader beer category. So besides the, value-seeking behavior, low-income versus high-income consumer, Hispanic consumer weakness has been a thread in a lot of earnings reports and a lot of commentary from companies on just concerns about going out around some of the immigration crackdown from the administration.
I don't think it's the first time Constellation has referenced that particular dynamic, is it?
No, because they rely heavily on the Hispanic consumer, and so they've seen that, but clearly that was a theme this quarter. And in general, beer's been a weaker category, so they see it even in the high end as well. It depends what categories you're sitting in. But overall, to your point, consumer spending isn't growing as fast as it was this time last year, but it's holding up very well despite the tariffs.
Right. Meantime, a little nibbling here off the opening lows this morning. Dow's now down 314. Let's dig a little further into the markets. The Dow sliding a few minutes into the September trade, although off the lows, digesting PMI, ISM, all ahead of the jobs number on Friday. Joining us this morning is Bespoke's co-founder Paul Hickey to discuss. Paul, let's get the fall started. Good to have you. Talk about September seasonality and whether or not there are elements that might make this particular round of September maybe a little less than feared.
Yes, September, we all know it's historically a weak time of year for the markets overall. Especially, look at what we've done the last 4 months. We're up 1% 4 months in a row. Coming back, that we're in an overbought market, so it's not surprising to see some weakness this month as investors reassess things and come back to reality, so to speak. But if you look back historically at these positive summers, more than 1%, 4 months in a row, September was mixed. The rest of the year was, continued higher. So I think if we do see a hiccup in September, it should be met with buying. September is historically, the weakness is back end loaded. You tend to see the weakest part of the month right towards the end of the month. As late as September 20th, on an average basis, September is actually a positive month. So in that respect, I think that'll line up perfectly with coming up with the Fed later on this month, how that plays out, and could be a catalyst for weakness if they don't give the markets what the market wants.
Yes. People sharing some 10-year charts of the Russell today, where we're getting into that neighborhood that we've knocked on the door on a couple of times since early 21. Do you think the theme of September will be about continued broadening or safety in the tech trade?
I think we'll see some broadening here. We came within like a point of the record high last fall, going back to, but last Friday went into second place for the longest streak the Russell's ever had without making a new high. That follows the Jackson Hole day, where we saw an enormous breadth, some of the strongest breadth that we've seen in small caps on record in a single day. And as long as rates at the long end of the curve, say the 10-year, remain contained, I think the broadening trade is intact. So if you stay under 450 on the 10-year yield, I think you can see the broadening small caps do well in that environment. As far as rates seeing a little bit of an uptick here, U.S. yields versus the rest of the world. They've been so contained in the U.S. versus the rest of the world. So that whole U.S. exceptionalism losing its luster, that whole idea, I think, is going out the window as we're starting to see stocks do better in the second quarter versus Europe and interest rates holding up a lot better.
Well, you said it all hinges on treasuries behaving themselves. So my question is on that. So interestingly, treasuries are selling off today. Yields are higher. Nothing spiking, nothing dramatic. But there is this idea out there. So the Court of Appeal shoots down President Trump's reciprocal tariffs, and whether that might actually be bond negative because of the fiscal concerns, the fact that tariffs were actually starting to raise a lot of money and be very positive for the bond market. It's not what we thought going in, but is that what's happening?
Yeah, so suddenly tariffs going away would be a bad thing. It's this market, things constantly change. The narrative constantly changes. I think, yeah, that could be a potential negative. Whether or not that happens, we still have the courts to go through with this. And if the Supreme Court doesn't uphold the tariffs, then you go into Congress. So there's still a lot to be played out. But yes, Sarah, if you do start to see that tariff revenue, not materialize, it would create a tenuous budget situation. But again, U.S. yields are holding up a lot better today versus the rest of the world, and so that's not the only thing going on in the treasury markets around the world right now.
Yeah, 30-year gilts in the UK, highest since '98. Today,
Yeah.
we don't have quite
Amazing.
that problem here. Paul, thanks. Good to talk.
All right,
talk
thanks
soon.
a lot, Carl.
Paul Hickey.
Big corporate news today. Kraft Heinz announcing it is splitting into two companies, undoing the merger originally envisioned by Warren Buffett. Becky Quick just off the phone with Buffett and joins us now with the details. Becky.
Hey, Sarah. Hey, Carl. It's good to see both of you. Obviously, what Berkshire Hathaway thinks about this is a pretty big deal because Berkshire Hathaway is the largest shareholder in Kraft Heinz. It owns 27.5% of that company. Well, if you're wondering what Buffett and Berkshire are thinking about this, here's the answer in one word: disappointed. Warren Buffett tells me that they were disappointed with them coming up with this idea, and then disappointed on top of that shareholders will not be getting a vote when it comes to what's going to be happening with this. He says that they will proceed to do from this point whatever they think is in the best interest for Berkshire on this. He said, if we are approached about selling our shares, we wouldn't accept a block bid unless the same offer is made to other shareholders. In other words, they're not going to sell a block bid in a deal price that they can get that the rest of the shareholders won't. If they haven't decided what they're going to be doing, but if there's a buyer who comes forward, it would have to be someone who was buying the entire company. Now, he did tell me, but Warren Buffett told me that Kraft Heinz spoke with Greg Abel about a week ago and said they'd been working on this a long time. Greg Abel told them that he'd be disappointed if they went ahead with this. And sure enough, a few days ago, word came back that they were going to go ahead with it anyway. Basically, they were informed about what the Kraft Heinz board had decided on all of this. I asked Warren Buffett why they didn't like this deal. He said, for starters, it should cost them about $300 million to implement this and additional overhead costs, and that it's going to take about a year to do so. So that's time that I guess in his view is wasted at that point. His words exactly to me were, it certainly didn't turn out to be a brilliant idea to put them together, but I don't think taking it apart will fix it. If you looked at the stock's performance over the last 10 years, you'd see a little bit of the pain that Berkshire's been in over this period of time, just over the last year. Yeah, you can see here, since the merger closed in 2015, stock's down by about 70%. It's been down about 20% over the course of this year, and it's down 3.5% this morning on this news. Now, this was a deal that Berkshire put together with 3G. At that point, they were very optimistic about what could be accomplished. They did squeeze out some of the overhead costs at that point. It looked like it was doing fairly well for a while, but it's been quite a while since that stock has had any sort of good performance on anything. Berkshire's people resigned from the board of Kraft Heinz. They had two designated board members who resigned at, I guess, Warren Buffett and Greg Abel's suggestion at that point. Back on May 19th of this past year, I guess they saw kind of where things were headed, weren't really in favor of it, so decided they didn't want to have their people voting on something along those lines. But if you look at this, again, Berkshire Hathaway is the largest shareholder by far, 27.5%. Berkshire has never sold or bought any stake. I think originally they were close to about 26%. Kraft Heinz has bought in shares, and that's what's boosted its stock to about 27.5%. But if you look at the list of other big shareholders in this stock, you're going to see its Vanguard Group at about 8.6%. BlackRock Institutional has 4.3%. State Street has 3.9%. Geode has 2.2%. Invesco Capital Management with the triple Qs has about 2%. Even if you add up those next five shareholders, that only gets you to about 21% of the shares versus the 27.5% that Berkshire has owned. Now, obviously, it's been a long issue that Berkshire almost never is an active shareholder. They are passive shareholders. They don't like to get involved in this, but I guess this is a situation where that sort of passive investment has been taken advantage of to the extreme, to the point where even when they voice their opinions and say they're not in favor of something with a stake this big, they're getting ignored on this front. So again, it looks like Kraft Heinz shares this morning down by just over 3.6%. But again, the largest shareholder, Berkshire Hathaway, is disappointed by this move to split those companies.
So that's lots of questions, Becky. But one I was going to ask is, so can they do anything further to fight against it?
I don't know.
If they don't want to see this happen.
No, I think part of what they expressed was the disappointment that there won't be a shareholder vote on this. I believe that Kraft Heinz has held out the position that it is not something that they need to take a shareholder vote on, according to Delaware law. I don't know if there are New York Stock Exchange or other laws that would require them to do that. If you look at this, there's not another annual meeting. I think their annual meeting is in the spring of next year, maybe April or May. They did say this morning, Kraft Heinz, that this would be a deal that they anticipate closing in the second half of next year. So I think there would be a shareholder meeting that would take place before it. But that's the big frustration. I think that there's not a shareholder vote that's being taken on this.
Yeah, the shareholders didn't get a say. Yeah. You know, I went back this morning and looked at Buffett's comments to you a few years ago. He said I was wrong in a couple ways on Kraft Heinz. We overpaid for Kraft. It was sort of always a rare blemish, right, on the deal-making track record of Berkshire Hathaway and
yeah,
Warren
this is not paid off well for them. I think they just they wrote down the investments. Just in the last couple of months, they wrote down by several $billions that investment that they had made over this. They've been pretty clear that this was not something that panned out the way they thought it was going to. But if you look at that, since the merger closed, down 70%. So no, I think you can say that this is not something that's going to go on the positive side of their investments.
No, not a good one.
Becky, thanks.
Yeah,
Becky Quick watching KHC today. In the meantime, many of the president's global tariffs are in doubt, as you might know, following that high-profile court ruling on Friday. Our Eamon Javers has more on that this morning. Morning, Eamon.
Yeah, good morning, guys. We will see the president on camera today in an unrelated event this afternoon. So we may hear from him directly on this court ruling that came down late on Friday. But his top trade advisor, Peter Navarro, said yesterday it'll be the end of the United States if President Trump's tariffs are blocked on appeal to the Supreme Court. Navarro called the ruling, quote, weaponized partisan injustice, but says he feels very optimistic about the administration's chances in the high court. His comments came after that federal appeals court ruling on Friday that most of the president's global tariffs are illegal, holding in a 7-4 ruling that the law the president invoked to put tariffs in place does not, in fact, give him the power to do so. The court said the core congressional power to impose taxes, such as tariffs, is vested exclusively in the legislative branch by the Constitution. The president denounced that ruling on social media over the weekend, writing, without tariffs and all of the trillions of dollars we have already taken in, our country would be completely destroyed and our military power would be instantly obliterated. Now, the big question now, guys, for American companies is going to be what happens if the Supreme Court upholds this ruling, and what mechanism would exist for the federal government to have to pay back those huge sums it has collected so far. By the way, not the trillions of dollars the president talks about, but close to $90 billion, you could argue, in tariff income to the U.S. That would be going back to companies and out of the U.S. Treasury. So maybe bad for the deficit, good for the earnings of some of those companies, though.
The other element, Eamon, is how countries that have agreed to trade frameworks, and even those that haven't, how they'll use that in their own calculations about whether to negotiate with the U.S. or not.
yeah, a lot of those trade frameworks, Carl, are not legally binding documents, right? So a lot of those countries, in a scenario where the Supreme Court upholds this ruling, a lot of those countries could wash their hands of it and say, look, we were under coercion by these tariffs. Now that leverage has gone away, we're just going to walk away from this deal. So the president's going to be under a lot of pressure right now to get some of those deals across the finish line in terms of legally binding language so that those countries can't walk away. And then the question is, how does the president jawbone the Supreme Court here? The Supreme Court, likes to maintain its independence, doesn't want to be on the receiving end of an aggressive lobbying campaign from the White House. But you can imagine that the president wants them to rule and wants them to rule in his favor, and is going to be very vocal about that.
All right, to be continued. Thank you, Eamon.
That's right.
Eamon Jabbers. As mentioned, oil prices are climbing as Ukraine war escalations raise questions over the resilience of Russian supplies. This as a group of OPEC Plus members are due to meet and assess market conditions this coming weekend. Tortoise Capital portfolio manager Rob Thummel joins us now. So does this change at all the thesis on oil?
No, I don't think so, Sarah. We think that the oil market will be oversupplied in the second half of the year, and so we'll see oil prices just continue to decline and possibly hit and move into the 50s as we exit 2025 and move into 2026.
Why not? I mean, hasn't there been this idea that if President Trump is able to come up with some sort of deal around peace, that would change the equation about Russian production and its ability to export?
Well, and that is the wild card, and it's a great observation, Sarah. So if Russia's the third largest oil producer in the world, so there's no doubt if there's less oil supply coming from Russia, that could cause the oil market to become balanced or even undersupplied. We just don't simply think that that's going to happen, and so that's why we see oil prices declining, and that's probably good for the consumer and good for inflation as well.
Did India and China over the weekend at this summit reiterate their intent to buy Russian crude?
I think so, Carl. I think India is going to have to buy Russian crude in general. I mean, obviously, the goal would be for India to buy U.S. oil. The U.S. is the largest exporter of energy in the world, and the U.S. has oil that it could export to India. And so I think that would be the ultimate goal, is for India to buy more U.S. oil, kind of like what like Europe and South Korea have agreed to buy more U.S. energy in general over the next several years.
But what about that? I mean, how do you think about the geopolitics of China and Russia making nice with Xi and Modi? Wasn't that a snub to the U.S.?
Yeah. Well, I think at Tortoise, the way we look at it is we just look at simply, the U.S. is the largest oil producer in the world, and the U.S. is the most reliable oil producer in the world. And it's been that way for decades, and it's going to be that way for decades to come. We're one of the lowest cost producers, produce some of the lowest emissions energy in the world. And so ultimately, countries around the world, yeah, there's going to be a lot of geopolitics go around, but fundamentally, the U.S. is the place to buy energy.
Understood. What about this OPEC meeting, OPEC Plus this week? What's at stake?
Yeah, I don't think that there's going to be much of a change now. So OPEC Plus is bringing back all of the the voluntary production cuts that they agreed, and they're in the process of adding those volumes back to the oil supply or to the global oil market. That's why we think the oil prices are coming down, because the global oil supply that OPEC is bringing back is going to obviously exceed the demand, and we're going to have an oversupplied oil market, and so that's going to put a lot of pressure on oil prices for the second half of the year and into 2026.
Finally, rig count every Friday continues to defy expectations for even a slight uptick in the number of operating rigs. Do you think if prices stabilize here in the high 60s, that could change?
No, Carl, I think U.S. oil production, at least for now, is going to be temporarily flat to down for the rest of this year and into 2026, as the oil market needs to get balanced again, right? So if we're oversupplied, we got to get rebalanced, and part of that equation will be lower U.S. supply growth, and maybe the U.S. supply declining a bit. And so no, I don't think you're going to see a big change in the rig count. I think the rig count will probably keep declining, and U.S. oil production will be flat to down for the rest of the year and into 2026.
All right, Rob, thank you for joining us on a number of the key headlines moving oil prices. WTI just below $65 a barrel. Rob Thummel from Tortoise.
Still to come this morning, former Fed Vice Chair Alan Blinder's with us with his expectations for this jobs number on Friday and some of the possible outcomes of this ongoing battle between Fed Governor Cook and the president. And after the break, Pepsi's moving higher as this new activist enters the space, pushing for some major changes at the food and beverage giant. We'll get to all those headlines after a short break.
PepsiCo shares are rallying today. I've confirmed that activist investor Elliott Management has built a roughly $4 billion stake in the company. The stake would make it one of PepsiCo's top 5 active investors and one of Elliott's largest equity stakes ever. PepsiCo just telling me this morning, quote, PepsiCo maintains an active and productive dialogue with our shareholders and values constructive input on delivering long-term shareholder value. We note Elliott Investment Management's disclosure of its presentation and will review its perspectives within the context of our strategy to drive sustainable growth. And then they go on to say that strategy includes targeted investments in innovation, portfolio transformation, international growth, as well as corporate-wide multi-year productivity initiatives. We are confident that the successful execution of these initiatives positions PepsiCo to accelerate growth, strengthen our competitive advantage, and deliver meaningful long-term value for our shareholders. So not much there. Look, I mean, it's clear that these two are talking. There's a dialogue there. And Elliott did put out about a 75-page white paper that I've started to go through. A lot of the recommendations, first of all, one big question was, are they recommending a split of the beverage and the snacks business? I don't see that in this initial public disclosure, at least, both the letter to the board and also in this white paper. They recommend specific fixes say that a lot of the problems for the underperformance and the financial performance of PepsiCo are within their reach, basically their self-help story, and that they can fix them. For example, PepsiCo North America, they recommend, interestingly, a lot of strategies that Coca-Cola, their rival, has done. The bottlers, for instance, the bottlers was that's something that's Pepsi's been under pressure for a long time to try to do that, to sort of get rid of the bottlers in the system, to also sort of focus and narrow down the portfolio in terms of SKUs and products, something a lot of the consumer packaged good companies have done to great success. Maybe Kraft Heinz problematically had too many, too complex of a portfolio, hence the split today. And then on the snack side, the underperformance of snacks, I think there's some recommendations there to right-size the business as well. Look at, for instance, what's in the portfolio. Elliott recommends looking at, for instance, divestment of Quaker. For instance, Quaker, which has a lot of different products, everything from oats and granola bars to syrups and sauces. So maybe that's something to sort of streamline the portfolio. But so far, there's no call for a split. There's nothing public about changing management or anything like that. It looks fairly friendly. And as I understand, there is an active dialogue there. Pepsi, as far as it's concerned, I mean, we talked to Ramon Lagarta at the last quarter. They had a good quarter. They showed some signs of growth and some signs of turning it around. A lot of productivity measures in place, for instance, and streamlining. So maybe there's some common ground between what Elliott is suggesting here and what Pepsi is already doing. But clearly they think that there's a lot of value here and they're in it for the long term. One thing, Carl, I would note is that Elliott hasn't done much in the consumer packaged goods space. They were in Starbucks, and they've been in big American,
yes,
well-known companies like
places,
Salesforce
yes.
and
Yep.
Honeywell, but not as much in food and beverage. Remember, Nelson Peltz and Trian had a fight with Pepsi. They wanted to split the businesses years ago under the previous CEO, Indra Nooyi. Wasn't successful.
No, her argument was that people like bubbles. Remember that? Oh, we did have Celsius
Scale.
on Friday because
Yeah.
Pepsi increased their stake in Celsius, and we asked him whether or not he thought Pepsi was starting to favor beverages over snacks, but he wasn't willing to speak for Pepsi, obviously.
I mean, beverages are still, 40% of the portfolio. It's an important part of the business. It's North America that needs help, both on the beverage and on the snack side. International has been a good growth story for Pepsi, but the turnaround, whether it's happening fast enough or good enough, I think investors are excited here a little bit. Stocks up 2%, that what Elliott can bring to the table, and the fact that there's some self-help fixes, which is what I would say, again, is the crux of the argument here from Elliott.
Yeah, back to flat for the year after a tough summer, obviously. Meantime, resetting here around 6,400. Let's get a news update with Silvana Hanel. Hey, Silvana.
Carl, good morning. A federal judge said today President Trump illegally sent thousands of military troops to Los Angeles in June. He said the president effectively turned 4,000 National Guard and 700 active duty Marines into a national police force. It's the latest update in the California governor's challenge of the president's authority to send the troops to L.A. to respond to immigration protests. The Trump administration is likely to appeal. The trial of former Brazilian President Jair Bolsonaro entered its final phase today as the country's Supreme Court began hearing closing arguments. Bolsonaro is accused of staging a failed coup to remain in power after he lost his 2022 re-election bid. President Trump has called the trial a witch hunt. And New York Representative Jerry Nadler announced today he will not seek re-election next year. Nadler's 34-year congressional career makes him the longest-serving member of Congress from New York. He told the New York Times it is time for generational change in the Democratic Party, Sarah.
Okay, thank you, Silvana. Just the latest to warn about that. Still to come, healthcare, the worst performing sector on the year now as headlines grow around regulation under RFK Jr. We'll get Raymond James's take on what's next for the group in a moment. But first, former Federal Reserve Vice Chair Alan Blinder ahead of a potentially game-changing ruling from D.C. that could give the president a majority on the Federal Reserve Board. The latest when Squawk on the Street returns.
18th.
Welcome back. Big week for stocks with the jobs report on deck Friday, and investors awaiting a decision from the courts regarding Fed Governor Lisa Cook. Former Federal Reserve Vice Chair and Princeton professor Alan Blinder joins us now to discuss it all. How do you think about what's at stake here with the Federal Reserve and this court decision?
I think the independence of the Fed is at stake, not immediately. I think you want to think of this as the opening step in a war on central bank independence. The next step will come this week, I think. Trump's new nominee, Stephen Moran, is coming up. I think it's this week for confirmation hearings. If it's not this week, it's soon.
Yeah.
And you know as well as I that the Senate has been confirming anybody. I mean, they would confirm a ham sandwich if Trump sent it up there for an appointment.
But that, okay, yes, but there's nothing illegal about that, and there's nothing wrong.
Nothing.
I mean, that's how it's supposed to work. The president is supposed to appoint Fed governors, and then the Senate's supposed to vote on them, and then they become Fed governors. That's not an assault on independence.
It does not have to be assault on independence unless he gets command, a majority on the board. That's why I mentioned this. He'd be one step away from a majority if he can remove Lisa Cook, which I think is illegal, but the courts will decide that.
Why do you think that's such an assault? Because look, whether it's politically motivated or not, if there was, and I'm not going to condemn her, but if there was evidence of mortgage fraud,
order filled,
isn't that grounds for firing without questions about central bank independence?
I don't know. That's a legal question. It's quite relevant that this was before she was a member of the Federal Reserve Board. And by the way, she hasn't been accused of anything yet. My point is that the Trump appointees are liable to take instructions from Trump. And that's the assault on federal independence. No, there's nothing illegal about him appointing somebody to fill a vacancy. Nothing at all. He's perfectly entitled to it.
I mean, I'm not sure there's any evidence that he would be taking orders from President Trump. I see your point. I mean, we've had Stephen Myron on the show many times. I think that he's a legit PhD economist who feels that rates should be lower.
Yeah, no, I mean, it's a debatable proposition. What's not debatable is the president wants the lower to mean like 1% interest rate. Any economist not in the employ of President Trump will tell you that's a wacky idea. It's not a wacky idea to lower interest rates a little bit, and the Fed may do that at its next meeting.
That is the strange part, is that he's just on the cusp of getting the cuts we think that he's so long craved. Alan, I'm wondering whether or not you think the bull steepening that we've sort of seen since the complaint about Cook, it represents anything regarding Fed independence, or is it more of a global sovereign debt story?
Well, I think if you just look at the bigger picture, you have the attempt to remove Cook, which I hope will fail. The new appointment, which was just pointed out, is perfectly legitimate, nothing wrong with it. Powell's reappointment coming up next year. And as long as those are filled by people that understand monetary policy and understand the role of the Fed, which includes respecting the independence of the Fed, I think it's all fine. In his first term, he appointed Michelle Bowman and Christopher Waller, and people like me didn't make a squeak of protest. That was fine. They were fine appointments.
Should the FHFA not point out whether when it finds that it has evidence of mortgage fraud? Should Fed governors not be investigated for this sort of thing?
They can be investigated. It certainly looks to me, and I think it looks to almost everybody, like a fishing expedition. It wasn't just Lisa Cook. It was, by coincidence, several Democrats who've had their files examined. Whether any of them have done anything wrong, I don't know. That's yet to be determined. But it certainly doesn't look like a routine piece of information that filtered up to the head of the agency. That kind of thing wouldn't filter up to the head of the agency in normal times.
No, you might not like how they do it, but ultimately, I think if they find anything, it's worth looking into, which you could argue. You know, I sort of understand more the criticism when President Trump was threatening Jay Powell, but he's repeatedly said that he is not going to fire Jay Powell, and he doesn't think that would be a good idea. I mean, to me, that this feels very different than that, as far as the implications for independence.
I don't think it should feel different in that firing the chairman is a much bigger deal than firing anybody else in the Federal Reserve system. But qualitatively, it should feel very, very similar. It's the idea of pulling people off the board prior to their time, illegally, I might add, in order to put your people in place. He will have a time. As you just pointed out, it's perfectly legitimate to nominate Mr. Moran for a seat on the Fed.
Okay, well, let's see what happens. We'll see what the court rules on whether the president can do this or not. We appreciate your perspective as always, Alan Blinder.
Very welcome.
Thank you. Coming up in the next hour, do not miss former World Bank President David Malpass, reported contender to replace Lisa Cook on the Fed Board of Governors if the president gets his way. He's going to join us at 11 a.m. on Money Movers. And then tomorrow at 8:30, Steve Leisman will have Fed Governor Chris Waller on Squawk Box to talk about this and policy and a lot more.
Still to come this morning, 9 former CDC directors calling on Congress to look into RFK Jr.'s actions at Health and Human Services, saying it's a danger to Americans. What that means for an already underperforming healthcare sector after this.
After a solid August, stocks are off to a rougher start for September, which has historically been one of the worst months of the year on average. But one trader is still looking for outperformance in a part of the market that's been making waves on the upside as of late. Tune into our Market Navigator segment later on today on Power Lunch to see why bigger gains might be coming in smaller packages. That's at 2 p.m. Eastern Time.
Welcome back. Pressure continues to grow around Health and Human Services Secretary RFK Jr. In a New York Times guest essay, 9 former CDC directors penned a scathing piece calling him dangerous, added his leadership is, quote, unlike anything our country has ever experienced. Joining us to discuss the fallout today, Raymond James healthcare policy analyst Chris Meekins, also a former HHS Deputy Assistant Secretary. Chris, thanks for the time. Good to see you.
Thanks for having me.
We did hear Stephen Miller just last week call RFK Jr. a crown jewel of this administration. Do you really think he's in any kind of political jeopardy?
Well, Stephen Miller previously called him some really ugly things during the campaign trail, but magically when you endorse the president, all things can become possible. Look, when we look at the space and we talk to investors and we talk to people here in D.C., what's becoming increasingly clear to us is the president has a political reason to keep RFK around until after the midterm elections. He is absolutely laser focused on trying to make sure the House stays Republican so he doesn't get impeached again. You see his actions leaning in on redistricting and gerrymandering in Texas and other Republican states to try to maximize the number of Republican seats to try to hold on to his evidence of that. So we think RFK is likely, as our base case, safe until after the midterm elections, with the caveat being that there is a point in which the political cost of keeping him could outweigh the political benefits. The political benefits of keeping him are outweighed by the cost of some of his actions with really swing voters.
Right. Do you think those costs involve actual policy, or is it more about rotating headcount, mean op-eds in the Times?
Yeah, I don't think mean op-eds in the Times are going to determine the midterm election outcomes for House Republicans in the key states we're watching across the country. What I will say, however, is that some of the actions we'll be seeing around the autism report later this month or around changing the vaccine schedule, there are obviously some people that are skeptical of vaccines, but for the vast majority of the American public, making a big change that could result in their children not getting the vaccines they need could be politically problematic going forward.
You know, a lot of the weakness in the sector gets blamed on him and some of the changing policy, but I wonder how much is deserving of that. If you look at the worst performers, Centene, United Healthcare, I mean, aren't there other bigger problems happening in the insurance business?
Yeah, no question. The insurance space has been incredibly complicated. Centene, a lot of that's related to Medicaid redeterminations that were ending after the COVID emergency, as well as changes in the OB3 reconciliation bill that was passed that will cut Medicaid, as well as potential concerns over the future of the Affordable Care Act expanded subsidies. I think when we look at RFK, the concern really is in the pharmaceutical space. So when you look at whether it's the COVID vaccine makers like Moderna, you look at players like Merck and GSK, as we potentially will see changes to the vaccine schedule. You know, I think one of the most important things to watch really is this autism report. There's a man named David Greer in charge of it who's a vaccine skeptic. It'd be kind of the equivalent of putting the Cookie Monster in charge of dietary guidelines. We all know what the outcome's going to be. We know it's probably going to be unhealthy and unscientific, but we still have to navigate that for investors as they figure out what they could try to pin autism related to and what the impact on publicly traded names could be.
It's going to get interesting, obviously, going into flu season, a time where we sort of, on schedule, start paying more attention to health policy, certainly. Chris, hope to have you back soon. Thanks for that. Chris Meekins over at Raymond James.
He hasn't said anything about not getting flu shots, has he? RFK? I think we can still get flu shots, right?
All I'm saying is it's seasonal. Yes.
Right. All right, after the break, private markets moving out of obscurity thanks to a big new public marketing push. What's driving the move and why now in just a moment. As stocks continue to pull back here, we are looking at an S&P that is down a little more than 1% now. We've got most sectors in the red. Healthcare and consumer staples are outperforming a little bit, so is energy. But technology, industrials, financials, communication services, all under selling pressure. We'll be right back.
Order filled. Order filled.
Private markets are going public, at least when it comes to a new marketing push from the industry. Leslie Picker here with more on what's driving this trend. Leslie.
Hey, Sarah. Yeah, brand awareness is a relatively new concept for the 50-year-old world of alternative assets. Historically, the industry opted for a much lower profile, but that's changing, and it's changing quickly with the industry delving into more retail-oriented channels. For today's first edition of CNBC's new franchise, Inside Alts, we took a closer look at how Blue Owl is getting its name out there at the U.S. Open. You may have seen this terse exchange between players Taylor Townsend and Jelena Ostapenko last week. It went viral after Ostapenko from Latvia pointed a finger and shouted insults at Townsend, an American who had won the second round match. As the camera panned in for viewers to get a closer look at the confrontation, careful observers could see a Blue Owl patch emblazoned on Townsend's tennis dress. Now, she's one of 100 athletes competing in professional tennis tournaments around the world who are backed by Blue Owl. And this is part of the firm's strategy to raise visibility and drive curiosity, Blue Owl's chief marketing officer told me. To be sure, alternatives firms have to walk a fine line to get their names out there without commoditizing the product. The rub in the boardroom these days across the industry is to keep this allure of a velvet rope while also capturing a growing share of retail investors. It's not easy to do. To sign up for Inside Alts, click on the QR code that will be on your screen. There it is, momentarily, guys.
Well, we'll do that. I mean, it's exciting, and I think it's definitely there's plenty of news to digest. I wonder if that works for Blue Owl to put their name and to sponsor a tennis player.
Yeah, it's interesting because they put their names and sponsor 100 tennis players, and they're usually the ones who are competing against the challenger. So you do so at about $20,000 a patch, 100 players, it's about $2 million. But when you get those kind of viral moments, or you get a lot of viewers watching those, high impact matches, that has a bit more impact, at least from their strategic standpoint. That's what their view is, than maybe a 30-second spot that could cost maybe 10 times that amount. So that's kind of the thinking there, is they do more of the underdog strategy. They say that's akin to what the firm's ethos is too, growing up as an underdog in the world of private credit.
Yeah, frequent guest on Money Movers for sure. We'll see how much of that broader audience outreach works, and we'll ask you
talk tennis next time.
Yes, Leslie, thanks. Leslie Picker. When we come back, former World Bank President David Malpass, a reported contender to replace Fed Governor Cook, on the board. He'll join us next when Money Movers begins.
Order filled. Order filled.
Okay, now listen, sweetheart. This is a very old trick, and we're going to do this. And
today.
Us.
blackout hits. today.
All right, Carl, thanks very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The market's under pressure today. Global bond yields, they are rallying. The future of the Trump tariffs in doubt. And following that court ruling, we're trading all of it with the investment committee. On the case today is Josh Brown, Joe Terranova, Jenny Harrington, Jason Snipe. We'll show you the markets. We're basically at the lows of the session. As you see the declines there, and to no secret today, the NASDAQ is leading it. If you look at almost a 2% decline. By the way, this is the first back-to-back 1% declines for the NASDAQ since that so-called Liberation Day. So it's been a minute. Since, Joe, we've seen a tech sell-off like we have the last couple of days. Yields are surging everywhere.
They are.
And it's not just touching 5% on the 30-year here.
Yes.
Boons, gilts, almost everywhere you look. France. That is a significant story today.
I think that was the big story overnight. You had the UK gilt 30-year touching 5.72. That's the highest level in 27 years. So we've always said the question was, when you're looking at the three major balance sheets, consumer, corporate, and government, which one has the most stress on it? And right now we're seeing a reacceleration of the stress on the governmental balance sheet. What that means for the equity markets is the most loved areas of the market, the areas of the market where momentum has been the catalyst, where bullish people like myself have advocated for owning, those areas of the market you're going to see working off some of the overbought conditions, some of the extreme sentiment, the bullishness surrounding it, and that takes you directly towards technology. You had the NVIDIA earnings the other day. Post NVIDIA's earnings, you've seen a little bit of a reversal, and it really is technology that's being targeted right now in this mild correction.
Yeah, more than a little bit of a reversal, right? I mean, NVIDIA has not traded well at all since its earnings release, and the selling feels like it's accelerated a little bit. There's what looks to me like an intraday. If you take, there's the 1 week. I mean, it's basically a flat line and then the boom. So we'll continue to follow that, but it really is an AI-related sell-off today, Josh. If almost everywhere you look in that space, that's where the most amount of pressure is as you come into September. Are you talking about a CapEx bubble like Sam Altman warned about? Are you talking about a return on investment from all of the CapEx that continues to escalate? Are you talking about stretched valuations? Are you talking about China competition? The Alibaba news wasn't good for the chip stocks last week. And there is follow-through, it appears today, on all of those fronts.
Yeah, I think that's right. Sometimes it's not as simple as trying to figure out who committed the murder in the Clue mansion, and we're looking for one specific person holding the candlestick, et cetera. Sometimes it's just an accumulation of things that make people say, you know what, I own a lot of this, maybe I don't need to own as much. I also think, like, you're post-catalyst. So I know Broadcom's going to report, and that's obviously a catalyst, but like the NVIDIA thing is the thing. So for this theme, if you held through earnings season, you made a lot of money. If you've been in these stocks since the lows in April, you made a lot of money. I mean, these stocks went absolutely crazy to the upside. And so now that catalyst is behind you, it's like, all right, I'll add all the things that you just said, Judge, and then I'll layer on top of it seasonality.
Okay, can I add?
And then I'll layer on top.
Can I add one thing real quick? I don't mean to interrupt you, but
yeah, please.
There's a story that just drops from the Wall Street Journal and like literally falls in our lap in this conversation. Anthropic completes new funding round at $183 billion valuation. I bring it up.
Right.
They finalized $3.5 billion at a $61.5 billion valuation. So they completed the round at $183 billion valuation. It just goes to exactly what we're talking about. Big numbers, spending, valuations, expectations, and whether, even with all of the legitimacy around the hype, whether all of these numbers can pay off.
Yeah, no, I think all of these things can be true. You can still be bullish on the theme between now and the end of the decade, which I certainly am. But you have to say to yourself, like, all right, I'm not the only person that gets it. Everyone understands that. There's a lot of money already invested in this space. Valuations are not low. Expectations are pretty high. And they've just gone on a huge run. But there's an underappreciated thing happening on a parallel track that I think is worth bringing up, which is there's a ton of money being made away from AI. International small value, U.S. small value, both outperforming the S&P this year. The banks are going absolutely nuts. I have 39 banks on my best stocks in the market list right now, which I think is the 39 financials, I should say. 7 of them are banks. Historically, this year, it's been mostly capital markets related stocks, and now it's banks themselves. There are a lot of new stocks that people haven't looked at in a while. So the biotech starting to get going. The XBI looks pretty good. So I think there's choice. And so you might have somebody that says, well, you know what? I just rode NVIDIA up from 150 to 180. Maybe I take a little bit off and I look at some of this rotation into other sectors that I've been ignoring up until now. So I don't think it's an emergency, Judge. I just think it's people doing a combination of profit taking, recognizing that valuations and expectations are high, and getting excited by other areas of the market that are working. And it's been a while.
Yeah, it has. So Jenny, we obviously are on a weak hand here as we enter September. I mean, how are you thinking about everything in the context of the tariffs, the areas that have led? There's more scrutiny over the AI trade. Industrials are weak today. Financials are weaker today. These are the winning sectors.
Yep. So I think a lot of when you say, how are you thinking about it, right? Really, to me, the theme that keeps popping back into my head is manage your expectations. We need to remember that last year the market was up 25%. It was up 26% the year before that. We're still up almost 10% this year. If we were to end 2025 up 8% or up 7%, I would consider that a massive win. So let's not get too hyped up over this pullback. But at the same time, I think you need to be really serious about rotation. I was just looking at this thing that's a list of the top performing stocks year to date, and it feeds into exactly what Josh was saying. Palantir, okay, that's the only one that kind of fits that AI-ish theme. Newmont, Seagate, GE Vernova, Western Dig, CVS Health, GE Aerospace, NGE. Those are the stocks that are up the most this year. Those things are all up 50, 60, 70% on the year. So there's this definite rotation. And then I found this morning interesting. I read a bunch in the morning, and there's definitely negativity moving in on the AI theme. So I don't know if anyone's heard this term. I just heard it this morning. It's called clanker. And clanker, it says, has become a go-to slur against AI on social media. And it's talking about how people are starting to revolt on it, saying hey, don't take our jobs. Hey, that looks really fake. That music's terrible. That image isn't great. And so there's that revolt. And then at the same time, there was another article out this morning saying China's pursuing a more practical and potentially cheaper AI strategy. So that, I would argue, would continue to take the wind out of some of the AI leadership that's out there, just in terms of valuation that we've seen. So I think the market could still end up fine this year, but you should consider rotation. You should manage your expectations. When we talk about what's the next leg up, I don't see how we go from up 10% on the year now to up 20%. I think if we just manage our expectations and say, look, if we end up 6% or up 12%, that would be just fine. So I'm not really fiery on the subject for a change.
So on the issue of bond yields, which need to be closely watched. Ed Yardeni today talks about the bond vigilantes might start acting up again if they can no longer look forward to a significant reduction in the federal deficit attributable to tariff revenues, right? It sort of hangs in the balance for the moment. I mean, the tariffs are staying in place until the legal system has its final judgment day on all of that. As long as we're talking about yields rising, it's going to be hard to talk about stocks rising as well, isn't it?
There's no doubt about it. I mean, there's a reasonable alternative, right? Obviously, if the 30-year trading at close to 5%, the 10-year jumping pretty dramatically, and then this concern around tariffs and how this story is going to play out. $90 billion potentially as a tariff refund. You're talking about a lot of these dollars being able to pay down the deficit that we have. So there's definitely some concern. And then obviously the AI thing that we've been talking about, where there's digestion, there's a lot of hype, a lot of CapEx talk that we've heard through earnings, and looking at other sectors as Josh described and Jenny described, and other names that have done well. So I think you put that in the crock pot, and I think that's what is kind of driving us down a little bit. And, it's a turn of the new month, right? Seasonality is a real thing. whether we believe it or you subscribe to it or not, September is traditionally the worst month in the market.
I get that. And by the way, there are people talking about that too today, in which some are suggesting, don't fear September. Why? Because earnings have been great. The momentum's going to continue there. Rate cuts are coming, probably in September. Market's betting big on that. After that, who knows? The AI trend is intact. And then you've had record highs in the market, which isn't a bad thing usually heading into September. I just go back to, by the way, Anthropic has confirmed on its own this raise at a post-money valuation of $183 billion. Should we just assume that there's room in the sandbox for every large language model builder, and that what is OpenAI at whatever it's valued at now, I don't even know, $300 billion? Anthropic and, Perplexity is out there talking about, and people are speculating about certain deals that company is doing, and there's others. Should we look at these large numbers and just say, hey, man, everything's great. This is to the moon and beyond. There's room for everybody to play equally, and thus the valuations are going to continue to surge?
Remember
no,
Netscape?
that would be rather foolish to do that. Yeah. One of the things that for the better part of this year I've been trying to look forward and understand is what will the effect of OpenAI actually going public be on right now the resting Mag 7 and the AI Halo universe. And I'm not necessarily sure there is enough room when they go public for capital.
In other words, they got to get capital sucking from somewhere.
That capital is going to come from somewhere, especially if you're in an environment where we're saying, okay, the AI thesis might be maturing somewhat. The AI thesis, as Josh accurately...
That's a controversial statement in and of itself.
Well, it
might be maturing.
It's mature.
People are talking about the second inning.
It's still maturing.
Hold on, let me finish my thought. It's maturing if you correlate it to ownership.
Is more mature than an
correlate it to the ownership. Josh made a strong point on this. We know that people have allocated towards the AI thesis. That's a well-known understanding within markets. It's not as if we're saying out of nowhere, hey, we've got this AI thematic investment strategy that you might want to think about. We have people, friends of ours on the show, who are launching ETFs surrounding the AI thesis. So there is a maturity in terms of positioning itself. And I really call into question the ability for some of these companies which are private now to actually IPO in 2026 and not see capital move away from the dominant players.
No, there are, if you look at some of these AI adjacent names or AI pure names, the power names over the last month are down a bunch. Vertiv, Vernova, Constellation, Vistra, Eaton. Certain areas that play in the industrials are down. We mentioned what's happening in financials too. We'll get back to that also in a minute. The chips are being scrutinized, I think, Josh, in a way that it's like if you're in the AI space, by and large, you're good. If you're not like right in the ball game, maybe you're not so good. Chip equipment names have been scrutinized. Lam Research downgraded to underweight. That was at Morgan Stanley today. You sold Lam Research. Why'd you do that?
Well, that was a stop. So that was a name on my best stocks in the market, but then they reported earnings and the stock sold off. And I tried to use the weakness as an entry. The stock went up initially, rolled my stop up, but then I didn't end up making any money. That's a trade. I think the main event for the chips sector is to have Broadcom come out on Thursday and basically reiterate everything that NVIDIA just said about the demand picture. So just to give people a quick idea, the revenue expectation for Broadcom is $15.8 billion. So that would be a 21% year-over-year increase. On earnings per share, they're looking for a 34% year-over-year increase. This is important. Broadcom is the 7th largest company in the S&P 500 right now. It's another $1 trillion+ market cap company. And again, they have to give you I don't think they have to come out and say 3 to 4 trillion in capex the way Nvidia's CFO did, but they have to at least ratify the health of demand for chips. And they're not head to head in the same chips, but it's all part of this big AI theme. I think on the equipment side, Judge, so Lam Research, Applied Materials, and KLA are the 3 big names there. I mean, these stocks are high beta names. I still like Lam a lot fundamentally. Technically, I have to wait for it to set up. I like that the best of the 3. But in the end, like, they're still cyclical. As excited as we all are about this secular AI once-in-a-lifetime build-out story, chip equipment is any capital equipment. It's always going to be cyclical. And I think a lot of people that are in these names, they've had huge gains, and now they're worried about, are we seeing the peak of the cycle? And I'll leave that to the semiconductor analysts to decide. I won't be the one that sees that coming, which is why when I'm involved in these names, I'm typically using stop losses.
Yeah. CNBC Pro today, by the way, if you look at how people are positioned or the stocks that are most in favor as we head into the fall, thought had a really good read. I encourage you to check it out. And if you're not a member yet, think about it. The most loved stocks among the retail community heading into September, no surprise, I think from the top 2, NVIDIA and Palantir. Big net orders from the retail cohort. Interesting, Walmart on the list. So there's AI and then not necessarily pure. Walmart, CoreWeave, Snowflake, AMD, Robinhood's going to surprise nobody by being on the list. SoundHound AI, Hims and Hers as well. You have some play around this way.
I do. Look, it just speaks to the nature of active trading and how it's intensified over the last several years. And active trading is looking purely at stocks that are going from the lower left to the upper right. You're not going to see names on this list like Merck or Pfizer or names that are struggling like a Lululemon. These are stocks where people are looking at them and saying, okay, I can get rewarded quickly. A lot of these stocks, they have fundamental justification behind their appreciation. Some of these stocks, maybe you could call into question and be a little bit skeptical about that fundamental representation. But that's really what this is. It's momentum in its purest form, and it is a grand part of the marketplace.
Well, industrials have had a lot of momentum, but not so much as we start September. Jenny, Carrier, Stanley Black & Decker, UPS. I mentioned if you can easily draw a line from the AI industrial type names like that you mentioned, GE Vernova.
Yeah.
Some are utilities, some are considered industrials like that one. But then there is, I mean, the ISMs, manufacturing ISMs were weaker than expectations today. Carrier, Stanley Black & Decker, UPS, 3M, Honeywell, rails and truckers are all having a tough session.
I think the problem with particularly the UPS, Carrier, Stanley Black & Decker, with those, the problem is that the tariff noise has overwhelmed whatever else is going on. And things like, for UPS, what the de minimis packaging pricing is, and for Stanley, what tariffs really are going to be. Everything else is eclipsed by tariff noise, and that's what one of the problems with what's going on today is. It just adds in uncertainty. And so as an investor, it's very hard to make decisions when a huge part of the business is going to be impacted by that. And by the way, for the management teams, it's very hard too. So I think that's the real story here. It's less kind of bigger economic.
What do you think?
Yeah, no, I think as it relates to the theme and the de minimis story, I think is a big story, right? Because I think you don't think about pricing power and the cost to the consumer. The consumer has held up relatively well thus far, so I think that's a big story, especially for the industrial names and obviously the transport names, right? As it relates to some of what Joe was saying about some of the software names, and I think about a Snowflake being on that list. Snowflake, when I think about AI themes, data warehousing, which we were talking about last week, is so important. That serves as a chassis for information. This is what the large language models are built off of. So you cannot buy indiscriminately in this space. I think you have to really be look at names and understand the fundamental stories, as Joe said, but you can't just buy them all, obviously.
Let's spend another minute, Josh. I don't want to sort of gloss over your best stocks in the market list. With, by the way, another CNBC Pro edition of late. Because what's interesting to me is the reason why we moved it up into our A block is, number one, financials have been trading so well, but that you make the declaration that it's the smaller banks that are actually breaking out. You like one chart especially, but can you give us a little bit more on that theme?
Yes, absolutely. As I mentioned, financials have been leading the best stocks in the market list by volume pretty much all year. But a lot of them have been, asset managers, broker dealers, insurance. Now we're starting to see actual banks, and not just JP Morgan, Citi, and Bank of America, which are on the list, and we've talked about them. But now I got big regionals. I got PNC, I got Truist, and I have Huntington Bank, which is the one I wrote up today. So the Journal had a story over the weekend talking about the fact that with mortgage rates down 9 out of the last 12 weeks, there are currently 2 million homeowners who could save money if they refinance. That's up from 1.7 million homeowners as of the end of July. So with every passing month, mortgage rates are ticking down slowly, but it's happening. If we get down to 6%, there would be 6 million people in the United States who it would make sense for to go refinance their mortgage. It would have to be 0.75 percentage points below where their mortgage was struck. That's like the magic number for when people say, hey, wait a minute, I'm paying too much interest on my mortgage. So that's a very powerful catalyst for the regional bank stocks, Judge. And mortgage refinance activity is only the tip of the iceberg. So the capital market stocks have already benefited from the bull market. And now if you start to get even 1 or 2 rate cuts, mortgage rates continue to come down, you're going to see this boom in demand for loans. You're going to see refinance activity. You're going to see existing home sales pick up. Huntington Bank, if you want to pull this chart up while I'm talking, this is a no-brainer to me. I'm not in the stock yet, but I may be at some point. I don't believe in triple tops. So what you can clearly see is this stock hitting its head against the same level. This is now the 3rd time it's trying this high 17s, low 18s resistance. I think she breaks through this time. A lot of these regionals have the same kind of inverse head and shoulders, which if you squint at what's on screen, you can see for yourself. And they're all in golden crosses, and many of them are making new highs, which HBAN recently did. If you pull that chart back longer, you can see there's a lot of room. So what we're saying here, traders can use 1550 to 16 as their risk management, as their line in the sand with a stop. I think longer-term investors just swim naked. Don't even bother. The 13 PE ratio, 3.5% yield. I think you've got that cushion. You're risking the stock as recession, but guess what? That's your risk in every other stock. So this is an example of an area of the market we were talking about. I'm not suggesting people are selling NVIDIA and buying Huntington Bank. I'm just saying there are other parties going on, not just the one party. And that's what's notably changed in the market, I think, over the course of the summer.
Joe, you've been in that party. You've been at the regional bank party. At least you think it's going to continue.
I saw you there.
I do. Look, Josh and I look at markets in a very similar regard. We respect and understand price appreciation, the benefits of it, and how to invest towards it. I've said this over the last several months ad nauseum about the fact that the Joe T strategy in the early part of 2024 aggressively moved to an overweight of financials, despite a degree of skepticism on my part. And Josh is right. When he talks about early on, it was insurance companies, it was asset managers and brokers, and it's billed to be something more than that. It is regionals. And I have to tell you, I was surprised. We have a 35% weighting to the financial sector in the strategy. I was surprised at the last rebalance that we kept names like Citizens Financial Group, like Huntington Bank Corp, like Regions Financial, like PNC, like Fifth Third. All of these regionals stayed anchored within our sector holding. And I think it's indicative of a potential opportunity. There's underneath all of this, there's some catalyst. Whatever that catalyst you want to try and identify it to be, that's fine. Maybe it's regulation. Maybe it's what Josh is talking about with rates. Maybe it's pure valuation. But there is a catalyst.
You got real quick on that? I got a news flash I got to get.
Here's my concern is that a lot of those stocks are up nicely. I agree. The financials of regional banks look good. But here's my concern. Last year, we cut 100 basis points and it didn't touch mortgage rates. all the hope continues to be that we're going to cut interest rates again this year, short-term Fed funds rate, and that mortgage rates are going to come down. What if they don't? Like, does the regional bank thesis, does the large bank thesis still hold up in the same way if the longer end of the curve doesn't follow the short end? I don't think it does.
All right. Kate Rogers has a
Net
market
interest
flash.
margins stay high.
Hang on, Josh. I got to do this with Kate Rogers on Starbucks. Hi, Kate.
Hey there, Scott. Starbucks announcing its latest menu innovation. Protein cold foam is going to be coming to stores in the U.S. and Canada on September 29th. Now, in addition to the cold foam, there will be a line of protein lattes and protein-boosted milks. The company is saying this will deliver between 15 and 36 grams of protein per grande drinks, and they're going to come in sugar-free and unsweetened choices as well. These are just the latest menu changes under CEO Brian Niccol, who is approaching the one-year mark at Starbucks. The company also just had its best ever sales week across U.S. company-operated stores. It says thanks in part to its fall menu launch and green apron service platform focusing on hospitality. But once again, those protein drinks coming end of month. I know it's something that the Wall Street community in particular has been watching closely. Scott, back over to you.
Okay, thanks. That's Kate Rogers. Stock just ripping on that news. Not really.
I drink bone broth. That's my protein.
All right. Yeah. All right, up next, we're going to do our calls of the day. A big downgrade in the metals market. Gold hitting a fresh all-time high. Silver's on the move as well. We'll discuss next. All right, welcome back. Gold, all-time high. Silver nearing its own record high today. Best levels for that metal since 2011. Newmont Mining was downgraded today to neutral from outperform at Macquarie. That stock hit a new 52-week high despite that earlier this morning. You own Newmont.
Yes, we own Newmont in the ETF. Look, ownership of gold is something that I think is important to have right now in a portfolio, just from the perspective of the challenges that I mentioned at the top of the show for governmental balance sheets and rising bond yields. Also, when you think about the commodity complex, it is inarguably the strongest of those, in particular with black gold, oil, down for the year.
You have Freeport, not like a gold or silver play, but
Yeah, not technically, but Freeport's actually the world's 9th largest producer of gold, and they sold 1.9 million ounces last year, which is $7 billion, but nobody pays attention for it. So I think one of the challenges in all the mining stocks are, again, tariffs, and what do you do with them? So on the one hand, we have this nice little gold perk at Freeport. On the other hand, the share price got completely sloshed around earlier because of tariffs on copper. Bottom line is it trades at 18 times earnings, has a 4% free cash flow yield, and huge earnings growth, like big double-digit earnings growth for the next few years. I think if you can tune out tariff noise, this is a nice way to get the gold perk, maybe with not that concentration.
Other calls today were focused on Netflix, reiterated buy, $13.90, price target at Bernstein. Jason Snipe, you own that stock. It's down 10%, by the way, from its recent high in June.
Yeah, at the end of June. So, I mean, the quarter was really strong. EPS growth was up 47% and revenue growth was up 16%. They're obviously really focusing on profitability. I think the margin story has been really nice to see. You know, the other thing is live programming, right? Crawford and Alvarez coming up in a couple of weeks. I think it's going to be a nice catalyst for this stock. And I think the content slate remains rich. They increased prices in January, and obviously the consumers swallowed that pill and continue to move forward. So I like this name into the second half of this year.
Jenny, Verizon assumed buy today. Goldman targets $49.
Yeah, trading at 10 times earnings with a 6% dividend yield. The expectations are so low that I think they kind of can't go wrong on this call. And it's not super inspiring from what the details of the call are, which is that consumer ARPU should grow, they'll continue to deliver, and then Fios fiber passing should also grow. That's not going to lead to much, but if it gets to $49, which is their price target, that's 12% capital appreciation plus 6% dividend yield. 18% in this market sounds pretty good.
We'll go to Christina Partsenevelos now. And news alert regarding NVIDIA, which seems to be responding to some rumors about supply constraints.
Yeah, which I was a little confused about. I even texted saying, are you front running something, because I hadn't seen as many rumors. But they're saying we've seen some erroneous chatter in the media about being supply constrained about the H100 and the H200 chips. They are saying that is false. They are not supply constrained. We have more than enough H100, H200 chips to satisfy every order without delay. So they are also saying that all of their cloud partners can rent these chips, but that doesn't mean they're unable to fulfill said orders. So they're just trying to let the market know that supply is not an issue, even with the H20s. These are the chips headed to China. They said that, even with the production of H20s, that's not reducing any of their supply for the H100. So it's not impacting, and they can satisfy both markets should the need be there. So they're just putting this out there because they're trying to get ahead of some rumors about them being sold out of supply, which is not true.
I wonder if in any way they thought that maybe what they call chatter, these are the words that they're using from their, the NVIDIA newsroom, that they posted on social media. They use the word chatter. They use the word rumor.
Erroneous chatter in the media.
Are they coming out and refuting that because they think maybe that those rumors and the chatter is in part why the stock has traded weak of late and then again today?
The stock, I think that's just a greater move with the chips in general. And you saw, some, Marvell numbers last week that disappointed Dell. And although AI servers are doing well, I guess it's the narrative of, the CapEx peak for AI is really weighing on it. For NVIDIA, the next major movers could be these tech conferences in the next week or so. But it was a kind of a situation where so many people got into this name before earnings. They got the earnings. It wasn't the blowout quarter that we'd seen in the past, and so now they're getting out. And we've seen this rotation out of chips in general just over the last 2 weeks. So I'm not necessarily sure it's company specific, but you constantly get these headlines coming from China and elsewhere that they're not looking to buy NVIDIA chips. So perhaps that's weighing on it as well.
Yeah, you just don't often see companies really give any credit or anything towards rumors or even respond to it. That's why maybe I'm
come
asking.
Back to you. I'll try to find a little bit more on this.
All right, Christina, thanks as always. Christina Partsenevelos. The headlines now with Silvana Hanau. Hi, Silvana.
Scott, good afternoon. A federal grand jury in Washington declined to indict a woman accused of threatening the president on social media. In a motion filed Monday for her release, lawyers for the woman, Natalie Rose Jones, said the jury didn't find probable cause to indict her on the charges, which allegedly included calling President Trump a terrorist during a voluntary interview with the Secret Service. Grand juries have declined to indict at least 6 times in recent weeks amid the president's federal crackdown in the city. North Korean state media has confirmed that Kim Jong-un arrived in Beijing today to join Russian leader Vladimir Putin and China's Xi Jinping. The three will attend a military parade celebrating the 80th anniversary of the end of World War II. And California Governor Gavin Newsom launched a major campaign today to change the state's congressional map. So there will be 10 ads circulating on TV and digital by the end of the week, which hope to drive turnout for a special election in November when voters will decide on the remapping question, Scott.
Okay. Silvana, thanks so much, Silvana. Now, coming up, we're taking you inside the private credit boom. Robert Frank standing by with exclusive insights today from one of the biggest players in that space. Halftime's coming right back after this. Welcome back. The Financial Times reporting today that Apollo Global planning to launch a $5 billion sports investment vehicle, the latest sign that private capital markets are booming. Sports as an asset class continues to boom. Robert Frank is following the money on this as well. Robert?
Scott, yeah, it's sport as an asset class and private credit as an asset class. In fact, private credit up 50% since 2020, now at $1.5 trillion. It's expected to nearly double in the next 5 years. Now, what started as loans to small and fairly risky companies has expanded to the largest corporates and tech giants. Meta, AT&T, Intel, others, all tapping private credit for billions in loans. Apollo Global CEO Mark Rowan said that private credit now is made less risky, but I asked him about returns and fees for investors. Here's what he told us.
If private markets do not produce excess returns after fees at the same level of risk, they should not exist. An investor should never take a private alternative to a public alternative if it's not producing excess return per unit of risk. So net of fees, The performance of private markets has outperformed public markets. Are fees higher in private markets? Yes. The fundamental difference between a public market asset manager and a private market asset manager, a public market asset manager will take any amount of money you give them and invest it because they get to buy what exists. And what exists reflects 100 years of creation.
Now for the full interview with Mark Rowan and to learn more about the revolution we're seeing now in alternative investments, you can sign up for the new Inside Alts newsletter out today. The first one, you can become a founding subscriber. You sign up at cnbc.com/insidealts or scan that QR code, cnbc.com/insidealts. Scott?
Robert, good stuff. Thank you. Robert, Frank, what do you think?
I think that the private equity space is going to continue to have penetration into sports. Sports are the entertainment vehicle that's not cannibalized by AI. Sports are the last bastion of where you cut back on your spending when you think about it at the youth level. And if you think to yourself, the major sports franchises and the growth in valuation for these franchises, take Jerry Jones as an example. Jerry Jones buys the Cowboys for $150 million, somewhere around there. They're now worth north of $10 billion. I'll let you guys figure out what the exact figure is. How do you get liquid on that? Yeah. So you reach a moment where for an individual like a David Tepper or a Stevie Cohen to step forward and buy a franchise, valuations become so exorbitant, it's going to be private equity that's going to have to step in to liquefy and create some of the wealth for these individual owners.
All right. Next, we are counting down to the Ryder Cup. We're following the big money in one of the premier golf events of the season. In fact, premier golf event. We're back after that.
Today.
Later this month, the best golfers from the U.S. and Europe will tee it up at the Ryder Cup on the famed black course at Bethpage. It is the first time the New York area has hosted the event in some 30 years. The matches will be broadcast over 3 days on the networks of NBC, including NBC, Golf Channel, USA, and streaming on Peacock. Jeff Price is Chief Commercial and Philanthropy Officer for the PGA of America. He joins us here on set. It's great to have you on. We're so excited about it, obviously.
Great to be here. And in 21 days, we're going to have spectators entering Bethpage to go in and see the practice rounds. Couldn't be more excited.
I mean, it's one thing to have a Ryder Cup in general. It's another to have it in the New York area. Bethpage, public course, where, for those who don't know, I mean, you famously have to sleep in your car.
You literally do,
to
yes.
get a look at this thing, and you have the official swag on. I mean, the excitement about having it in this area.
It's off the charts. The support from the community, the business community, has been incredible. We sold out of competition day tickets literally in 48 hours. We sold out of hospitality about 6 months ago. We have an amazing corporate partner family, companies like Aon and BMW and Citi, and Capgemini, Rolex, SAP, all of those companies activating globally, because this truly is a global competition. Europe just named their 12 players yesterday. 11 of those players played in Rome. They took it to us pretty good, but we have Keegan Bradley ready to bring a team that's going to come and fight hard here. At
he was pretty selfless too, obviously, and not picking himself.
He really put team over himself and his self-interest.
So speaking of hospitality, I mean that. You know, it's what everybody loves, obviously, a little bit of hospitality. And leave it to our friend Kenny Dichter, of course, and his Real SLX to up that. They are literally doing a Rayo's pop-up out there, like a physical structure that's going to look like Rayo's essentially inside the ropes.
We are building Rayo's near the polo fields at Bethpage, presented by Crypto.com. It's going to be Thursday, Friday, Saturday, and Sunday night. It's going to be an amazing experience. They've done these at other sporting events. We thought, why would you not bring it to the Ryder Cup? And Kenny and the team and Chef Dino, they're ready to have a great experience.
Yeah, it's some good meatballs for everybody, or at least if you can get a seat, which isn't easy. How many people do you expect out there?
Gosh, we probably will see up to 50,000 people a day.
A day
at Bethpage. And then, you know, for the Rayo's pop-up, we're looking forward to 250 guests a night. You know, there are no reservations, but if you're interested, check out Rayo's Ryder Cup at intersport.global, and you can maybe get a reservation or call Kenny.
We're excited. We're hosting an event out there too. My colleague Dom Chu is going to be there for the final round with an elite group of executives. Conversation about leadership and team building and finding success no matter how challenging the environment is. You looking forward to that?
We really are. We recognize that Sunday at the Ryder Cup, there are more CEOs and sweet seat folks than any other event. And CNBC came to us with the idea of, let's create a thought leadership opportunity. Obviously, you lead in thought leadership. We were thrilled to be able to partner with you, bring that together for wonderful execs. It should be a great conversation. And again, our friends at SAP helping to support that.
All right, we're proud of that too. It's good to have you, Jeff. Thanks so much.
Thanks so much for having me, and we're looking forward to a great competition.
Yeah, we'll be watching for sure. Be sure to catch the coverage of the Ryder Cup on Golf Channel, NBC, USA Network, and Peacock beginning on September the 26th. Up next, Santoli with his midday word.
7.
Senior markets commentator Michael Santoli is here at Post 9, and he says he is scrutinizing, or we are, conventional Wall Street wisdom into the final third of the year. What do you mean? What's conventional Wall Street wisdom?
I think coming into the week, the conventional wisdom was, or at least what the market was priced for, was this set of benign rate cuts into a steady economy while the AI theme also remains strong. So it's kind of like gain without pain. And you're getting tested on all fronts right now. I feel like you guys were talking about the chip gut check that we're getting and the general decline in the AI leaders. I mean, Microsoft, NVIDIA, Meta are in 8 to 10% corrections right now. Not a big deal given where they're coming from, but with yields up, it's impossible for the rest of the market to take up the slack in a very efficient, real-time way. So I think all that's going on. I am mindful that August 1st, you had a 1.5% decline in the S&P 500 to start a new month that everybody said was going to be a tough month. It was the jobs report day as well as the solidifying the tariff rates day, and that was the low for the month. It looked like it was okay, let's buckle up. And it literally was the low from the month. We tested levels from a couple weeks earlier. We're kind of doing something similar today, testing levels from literally the day before Jackson Hole. That's where we are on the S&P right now. So I feel like we priced for a pretty good scenario. We're not quite sure it's going to be clear sailing to those scenarios, and that's what we're trying to contend with.
Okay, I'll see you on Closing Bell. We will continue this conversation with Mike Santoli. We'll do finals right here next. Track this market over the final stretch today with Adam Parker, Chris Ferrone, Cameron Dawson. Mark Short's going to join us as well to talk about what he thinks ultimately happens with the Trump tariff. So I'll see you then, 3 o'clock Eastern time. Got about 45 seconds or less. Josh, final trades what?
Netflix, 32 times earnings, 32% growth expected.
Thank you. Jason Snipe.
Amazon, I know there's been some concerns on AWS. I think they'll reaccelerate here.
Down 2%. I mean, it's traded better than many of the other of the mega caps, but not by much at this point.
Yeah.
MPLXLP.
Yes, an old school.
I look right at Jenny Harrington with
Old
that one. I knew
school
it. I knew it.
Yeah, who would do that one? So it's got a K1, but it's got a 7.5% yield, and I think it's out of the fray of tariffs and interest rates right now.
All right, Joe T.
The refiner trade is breaking out. Valero.
Reasonably recent buy. All right, I'll see you on the bell.
Thank you, Scott, and the halftime team. Welcome to the exchange. I'm Courtney Reagan, and today for Kelly Evans. Stocks dropping amid uncertainty over what comes next on the tariff front after an appeals court ruled most of the president's global tariffs illegal. The Dow down nearly 600 points at the low. Now it's down just about 444. All three major averages, though, on track for the worst day since August 1st. Different story for yields. They are higher on the prospect that the U.S. may have to refund the tariff money. The 10-year at 4.28%, the 30-year hitting the highest level since late July, and risk-off sentiment sending gold to a record high, crossing the 3,500 level. Silver, meanwhile, trading at a 14-year high. But we begin in Washington and the tariff limbo. Eamon Javers has the latest for us. Eamon, what do we know now? This is somewhat maybe a surprise, but then the market sort of shrugging it off. What do you think?
Yeah, well, look, Courtney, we're going to see the president on camera today in just about an hour's time. It's at an unrelated event here this afternoon, so we may hear directly from him on this court ruling that came down late Friday. But his top trade advisor, Peter Navarro, said yesterday it'll be, quote, the end of the United States if President Trump's tariffs are blocked on appeal at the Supreme Court. Navarro called the ruling weaponized partisan injustice, but said he feels very optimistic about the administration's chances in the high court. His comments came after that federal appeals court ruling on Friday that most of the president's global tariffs are illegal, holding in a 7-4 ruling that the law the president invoked to put tariffs in place does not, in fact, give him the power to do so. The court said the core congressional power to impose taxes such as tariffs is vested exclusively in the legislative branch by the Constitution. Now, the president denounced that ruling on social media over the weekend, writing, without tariffs and all the trillions of dollars we have already taken in, our country would be completely destroyed and our military power would be instantly obliterated. The big question now for American companies, Courtney, is going to be what happens if the Supreme Court were to uphold this ruling, and what mechanism would exist for the federal government to pay back the huge sums it's collected so far. I've asked the White House and Treasury. They don't have any details on any plans or ability of the Treasury to pay back those tariff fees that they've collected from American companies. But some corporations have paid, as much as $1 billion so far this year to the federal government. They could be in for a windfall, and it could be a problem for the federal deficit on the flip side of that coin, Courtney.
Absolutely, and that's such a key question, is how would that actually work? I mean, would the government be quite literally writing checks to the tune of $1 billion or hundreds of $1 millions to some of these companies? I know once you find out the answer, you're going to give it to us. Eamon, thank you so much.
You bet.
Well, my next guest says the latest tariff developments haven't changed his market playbook into year-end. He sees tech and growth continuing to lead the S&P higher, with opportunities broadening out as rate cuts approach. Joining me now is Scott Croner, U.S. equity strategist at Citi. Scott, I'd love for you to just walk through what you think the market is reacting to here. At first blush, I thought, oh my gosh, stocks are going to soar because now we don't have potentially the handcuffs of tariffs. If now this is another court ruling saying, not so fast, Mr. Trump, you can't just put those in. But the opposite is happening. Stocks are down, yields are up. Can you just walk me through why you think that is?
Well, one guy's view, Courtney, but the way we're thinking about it is that, the market's been navigating and dealing with tariff-related uncertainty, since the beginning of this year. And as we move past the April lows, Liberation Day, and then Moratorium Day, and then all of the negotiations since then, the market, in our view, has gotten increasingly comfortable that fundamentals can survive even with a tariff backdrop. Now, we'd argued a while back that the tariff drag on S&P 500 earnings could be as much as 5%. That's been mitigated more recently by some of the tax reform measures with the recent budget negotiations. Now, here's the issue. If you thought you were getting closer to being able to navigate where tariffs are taking company fundamentals, and now you throw in this twist that maybe you have to rescind some of the tariffs, well, on the one hand, that's potentially an incremental positive for earnings. On the other hand, though, the market has also gotten comfortable that tariff-related revenues can be an offset to some of the deficit numbers. So you got a catch-22 here in terms of what part of this narrative do you want to focus on?
I mean, I understand all that, I suppose, but then when we just heard from a number of companies that reported that may or may not have had a tariff impact, many of them were able to mitigate much more of it than perhaps the market feared. That being said, because of all the deadlines and delays, not all of the impact was felt in the quarter just reported. Do you think that we're sounding relief a little bit too early?
We're seeing a few things, different things happen. You're seeing companies that have put out fairly, let's call it aggressive expectations for what they'd have to pay in tariffs, actually pull back on how much they think they'll have to pay. Okay. As time's passed and we've gotten further away from, again, those April proposals. Now, on the other hand, you've got companies that, were saying, hey, we don't think there's going to be that much of an impact, that are now citing maybe there's a bit more of an impact on some of their fundamentals. And then you got this third cohort where, particularly among some of the retailers that are reported, that our expectation was that they wouldn't be able to pass much through in terms of tariff costs to end prices, not enough consumer strength out there. So they'd have to eat it on gross margin. But you are hearing some anecdotes that these companies are now finding they can push some through. So what's happening here is that the tariff implementation is going down a fairly distinct company by company path. Makes it very difficult to look at it in aggregate and make a conclusion. But the bottom line here is I think we're going to continue to be navigating this ongoing drama for a while longer, for sure.
And before we sort of get to some of your picks, I love the point that you just made there about some retailers in particular being able to push on some of these cost increases in the form of prices, maybe more than they had previously thought. So if it turns out that these tariffs are no longer allowed to be implemented in the way that they are today, if you're a company, do you roll it back for consumers? And if you do that, then does that spur even more spending and then lead to more inflation because consumers are willing to spend anyways and now they can buy more?
That's a tricky one. I'm not quite sure how you would navigate that.
Sure.
I would expect that most companies or retailers in particular would roll back what they had envisioned putting in place. But this has all been a fluid situation anyway. And so it's unquestioned. I guess a big question as to whether you're actually rolling back or just resetting your expectations going forward. In any event, what it's doing is sort of reinvigorating the uncertainty that comes with this tariff discussion. At a time when the market's had a good run, is trading at 25 times trailing earnings. And so you're going to be very sensitive to incremental news flow that is disrupting some of this positive sentiment that's been so important to the market move over the past month.
And perhaps that's some very bright prevailing wisdom as well, as we just don't really know until we know. And this is still potentially a moving target if the Supreme Court especially has to get involved. So maybe markets and investors are only willing to go so far with extreme moves because it still is somewhat gray. But either way, you've got some picks for us. Before we run out of time with you, I'd love for you to go through ways that you think we can make money in this market, even if we don't have a crystal ball to how this is going to work out with tariffs.
Well, I think we've been leading with a tech mega cap growth focus, certainly off of the April lows. And so we're still sort of on board with tech via semiconductors, to a certain degree software. We like the communication services component, which is a combination of the media companies, which are the big internet plays. But we also like the telecom component of communication services, much like we like the utilities as well. Now, what's going on there? I think the one thing that we're having increasing confidence in, and you're seeing it in today's expectations, is that this next phase of Fed rate cuts looks like it's getting closer and closer. September appears to be mostly being discounted now. The city house view is that we could get potentially 2 more beyond September. So what you begin to do here is think about, where do I have beneficiaries of lower Fed funds rates? That's sort of my tech utility, my telecom utilities component. And then within financials, we think that it's not a bad environment. That is a steeper curve for many of the financial intermediaries, the banks in particular. So we're finding still things to do here. And what the messaging would be is use-related volatility around these ongoing tariff discussions and uncertainty to be legging into the more attractively positioned parts of the market where we still see very good earnings growth ahead.
I see. So potentially get in while it's on sale right now if you have a forward-looking bias that leans bullish. Scott Kroner, thank you so much for talking it all through with us from Citi. We're going to continue the conversation to a degree and turn to geopolitics. My next guest says neither countries nor companies should expect any clarity on tariffs following last week's ruling. But one thing the ruling does do is weaken the administration's ability to use tariffs as leverage in trade negotiations. And it comes at a time where Russia, India, and China are signaling solidarity to each other. For more, let's bring in Fred Kempe, CEO of the Atlantic Council and a CNBC contributor. Fred, thanks so much for being here with us. There's so much to go through, but I would love to get your take on what you think, what we heard from Friday and what that means. It's our understanding, as we just said, that you don't believe it really gives us any clear certainty, but what else does it provide?
Well, look, the Supreme Court is coming back in early October, so we have a month to talk about this. But this is uncharted territory. We have 2 areas where Trump is on a collision course with the Supreme Court. One of them is his authorities to bring about tariffs under the International Emergency Economic Powers Act. And the second is his power over the Fed, wanting to fire the Fed governor, Lisa Cook. It would be the first time in 112 years. The court doesn't usually like to go into international economic areas. It's something it likes to give up to the executive, arguing that it doesn't have the expertise for those things. But it's going to be inevitable that they have to do it right now. And then to the geopolitical situation, there's all theater in China this week. It's got the 80th anniversary of the end of the war, which is reinterpreting in many ways. We're going to have a big military award tomorrow. And it's got Modi from India, the leader of India, the leader of Russia, Putin, Kim Jong-un from North Korea, others, assorted others for the Shanghai Cooperation Organization. And they're talking about creating a new world order. It's more theater than it is a new alliance and a new structure. But theater is important right now if the U.S. can't propose a different theater, underscoring our relationships with NATO, our relationships with the European Union, our relationships with other world democracies. So I don't think we should take it too seriously, but I think it would be a mistake to ignore it at the same time.
I mean, all of this is interconnected, right? The president likes to use tariffs sort of as a negotiating tactic when he's talking to other countries about a variety of things that he would like them to do or not do. And you say, even if the Supreme Court says, hey, you can't do this, you cannot use this act in particular to institute tariffs, that doesn't mean that all tariffs go away or that there are other powers that the president may have that he could implement other tariffs. Is that right?
Right. If anybody thinks they're going to get some clarity in days or even weeks, they're not going to have it. There are a lot of tariffs that don't fall under the authority of this International Economic Emergency Act. That includes the ones to do with steel, with aluminum, with many other things as well. There's also sections that he can implement. Even if the Supreme Court should undermine his tariff policy, he can revisit it through other means, including Section 338. I won't go into too many details there, but he can put on 50% tariffs on countries without too much trouble. So he will definitely try to find different ways to keep this in place. Tariffs are not going to go away as a tool by the Trump administration because of the decision last Friday. He's going to continue to approach this. It's going to be a lot of uncertainty for a lot of time, and that's not good for running a business, and it's not good for trading on the markets either.
And then I want to go back to sort of the point you made at the beginning about political theater potentially with the leaders of all of these countries and the different things that are at play, whether it's India's relationship with Russia over pipelines and then how the United States isn't thrilled about that, or it's President Trump meeting with Putin in Alaska. I mean, that was sort of jaw-dropping, I think, to watch some of those pictures and to see the two leaders get into the same car and drive away. But really, nothing came of it. What does that mean for the long-term relationship between these two leaders and between our two countries?
Look, the tectonic plates are shifting. We're at one of the great inflection points geopolitically in the world, and that would have been the case before Trump's election in any case. You have this axis of adversaries that has been very strong. China, Russia, North Korea, Iran, they were there before, they're there now. What's new in China this week is India, a democracy that buys our defense, a democracy with which we've had good relationships, showing that it has a way to hedge against us with these new tariffs that we've put on India. So if you look at China right now, you're looking at China showing that it can be in charge. You're looking at Putin and Russia saying we have options, and you're looking at India saying we're hedging. And so we need to understand that there is a contest on for the future, and we have to engage in that contest. We have all the advantages, huge economy, and innovative economy. Everyone wants to invest in our country. People still want to send their kids to school in our country. And so we shouldn't overreact to what we're seeing on the world stage, but we shouldn't also underreact and not realize that there is a contest for the global future, and we have to engage in it.
Do you think the United States position has been weakened?
I think certainly the narrative has been weakened. I think the strength of our economy is as strong as it's ever been. The attractiveness of our markets is as strong as it's ever been. But it's really hard to ask your allies to engage with you fundamentally in a contest with China and Russia, while at the same time you're putting multi-digit sanctions on them. So we really have to get in a position where our allies know they're our allies. We treat them differently than we treat our adversaries. We take seriously our alliances. We have all the advantages in shaping this global future, and we just need to play to our strengths and play to our alliances and realize the built-in weaknesses of state-run systems like China, authoritarian systems that don't have the self-corrective capacities that our system has.
Fred Kemp of the Atlantic Council, thank you so much for being with us. As you pointed out, we've got about a month or so to talk this through before we see the Supreme Court back in session. Well, coming up, September is historically the worst month of the year for stocks. But what's the technical take on the market? We're checking the charts to find some opportunities. That's next. Plus, Klarna's long-awaited IPO is finally here. Again, the fintech giant's back on track to go public after pulling its plans back in April. What it says about the IPO pipeline ahead. The exchange is back right after this.
This is The Exchange on CNBC.
Welcome back. Stocks under pressure as yields rise on the possibility that the U.S. may have to refund tariff money. But amid all the uncertainty, there's a technical trend my next guest is watching that suggests one area of the market could be poised to break out, and that's small caps. For more, let's bring in Katie Stockton. She's managing partner at Fairlead Strategies and a CNBC contributor. Katie, thanks so much for being here. I'd love to sort of just get your take on the general market and where you see things moving, starting with the yields, because that is our big story of the day, if indeed the U.S. government is looking to have to refund some of the tariff money it's collected. What are the charts telling you about the reaction?
Yeah, the yields have been very much range bound. So for us, the takeaway is neutral on the charts, and that goes from an intermediate and a long-term perspective. So the best thing that we can do with yields from our seat as technicians is watch the support and resistance levels that are relevant, and they're actually very close by. So I think after this month's meeting of the Fed, that we will have some clarity as to which way this range is being resolved. On the downside, for the 10-year, we have support around 4.2%. And on the upside for the 10-year also, we have resistance around 4.4%. So those are the two levels that we're watching. A breakout from the range, of course, would suggest higher yields and vice versa. And if you look at history, when you do see rate cutting cycles, you tend to see yields correlated to that. So if that's what unfolds, well, then a breakdown is a bit more likely, and that would put secondary support around 4%.
Neutral seems to make sense with such a narrow range there between 4.2 and 4.4. What about the small caps? You know, we've heard a lot of fundamental analysis about why that group might be winners, but what are the charts telling you?
Well, the Russell 2000 as a proxy for small caps has exhibited very strong upside momentum, both intermediate term and short term, a really big push higher recently. That push higher does look overextended from a short term perspective. But if you can zoom out on the Russell 2000, you'll see what appears to be almost a big cup and handle formation. It looks poised to eventually lift to new highs, and that, of course, would be a positive catalyst. In the meantime, though, we do expect some consolidation aligned with seasonal influences at this time. And it's not based on seasonality that we get there, but rather just looking at the overbought conditions, how widespread they are, how far we've come, and how fast we've gotten here. And now, of course, we have a little bit of a loss of upside momentum for the large cap indices that we think will carry over to the Russell 2000 as well. It's evident in the S&P 500. We're even seeing some technology-related benchmarks take out their 50-day moving averages. So that's enough of an indication that we are in store for more consolidation here this month, and that would be very much fitting with expanding volatility as evidenced in the VIX, which is also above its 50-day moving average as something that's inversely correlated to the S&P 500.
We look a lot, of course, at energy, but most specifically crude oil prices, sort of as a proxy for what's going on in the macroeconomic environment. What do the charts tell you there as a macro read for crude oil?
It's still a secular downtrend for crude oil prices. In order to reverse that downtrend, we'd really need to see a move that's pretty substantial to the upside, just based on where there's resistance. So we're just watching levels, seeing if we're going to see a proper reversal of trend. There are some indications on the monthly chart of WTI to suggest that the low that we saw March, April was a major low. And that just comes from long-term oversold readings and upturns in accordance with that. We are seeing in the equity market on the energy front, we are seeing some signs of life there. If you pull up MLPs, you'll see a little uptick in momentum as some of those lift out of their prolonged consolidation phases. I looked at Phillips 66 at PSX for one this morning. That almost looks like an inverse head and shoulders formation. So we are seeing a bit more constructive technical action, even though the long-term momentum is still to the downside, just as it is for crude oil.
Very interesting. Katie Stockton with Fairlead Strategies. Thank you for a look through the technicals. Well, coming up, a historic opportunity. That's how activist investor Elliott Management describes the situation at PepsiCo, the firm taking a multi-billion-dollar stake in the company. The details and what they hope to accomplish at the legacy consumer giant is coming up next. Welcome back. Stocks starting September in the red. Dom Chu has a closer look at the day's biggest movers. Hi, Dom.
All right, so Courtney, we've got a food theme for today's movers. We're starting with Kraft Heinz, among the worst performers in the S&P after announcing it would split into two separate companies just about a decade after the brands were actually brought together. The companies have yet to be named, but the tax-free spinoff will focus on shelf-stable food brands like Heinz Ketchup and Kraft Mac and Cheese on one side, while the other will focus on grocery products like Oscar Mayer lunch meats and Kraft Singles. Shares of Kraft Heinz have been under pressure ever since the merger, going back to 2015, shedding roughly 60% of their total value, now about 70% since the merger actually happened, so keep an eye on Kraft Heinz. Meanwhile, on the beverage alcohol side of things, shares of Constellation Brands neck and neck right now with Kraft Heinz in terms of the biggest laggard in the S&P. Those shares are down nearly 7%. This is the company behind brands like Modelo, Corona, and Pacifico Beers, also Kim Crawford Wines and Mi Campo Tequilas, amongst others. It cut its full-year forecast due in part to continued headwinds for beer demand, especially when it comes to demand for premium beer brands among its Hispanic consumers. So keep it on Constellation Brands. And we'll cap it with a check on McDonald's, which is up just about maybe 1% or so, making it the biggest positive point contributor to a down day on the Dow so far. It's helped along by news that it's going to bring back its extra value meals as it looks to appeal to more price-conscious diners. Separately, the stock was also put on the conviction buy list by analysts at Goldman Sachs with some positive commentary about the brand's ability to weather an uncertain consumer environment. Now, keep an eye on those shares. Now, for more on that and other top analyst calls of the day, just head over to cnbc.com/pro. Subscribers get all the access to detail and context around those notable, Courtney, upgrades and downgrades. Back over to you.
Thank you very much, Tom. Now I'm very hungry. Reminds me I didn't eat lunch yet. Meantime, activist investor Elliott Management is taking a significant stake in PepsiCo. But despite today's 2% pop, shares are still only flat since January. Leslie Picker has the details. Hi, Les.
Hey, Court. Yeah, this may not be helpful in your hunger issues, but Elliott says if its proposal, if enacted, could deliver 50% upside to shareholders. The activist says Pepsi trades at a substantial discount to many historically slower growing peers, as well as to its own historical average valuation. The activist diagnoses Pepsi's underperformance as, quote, driven by persistent share loss and margin pressure within its North American beverages business, combined with a North American foods business facing decelerating growth and declining profitability. On the beverages side, which includes Pepsi, Gatorade, and Lipton, the firm wants strategic reviews of the brand portfolio and bottler refranchising and to reinvest in core products. On the food side, which includes Fritos, Lay's, and Doritos, Elliott is also recommending streamlining and right-sizing the cost basis with the current environment. In a statement, Pepsi said it's, quote, reviewing Elliott's perspectives within the context of its strategy to drive sustainable growth. Elliott says it's taken a $4 billion stake, making it among Pepsi's largest investors and one of Elliott's largest investments ever. But so far, it has not called for any kind of board change or firing at the C-suite level. Court.
Listen, this pretty much tries to undo what Buffett and 3G brought together some 10 years ago. I mean, what does the Berkshire Hathaway stake mean? It's still very substantial here, right? How does that play in?
Well, we saw actually about 10 years ago, Trian coming in and trying to separate these businesses. Elliott's not going so far as to say, you know, we want a spinoff here. We want, a full separation of the business at this point in time. They're calling for more of a strategic review. So perhaps it's something where the company ultimately splits in two. Perhaps it's something where they just kind of separate from underperforming businesses and do bolt-on of more higher growth acquisitions. So that kind of remains to be seen. They're leaving it in the hands of a review at this point in time. But I think, they've definitely gotten the attention of investors today. All those shares have come back from, the initial announcement that they were taking a stake.
And Elliott's sort of past history with some of these campaigns or maybe recent past, do you think they've got a good shot at making some changes here?
Elliott is among the most feared activist investors among corporate America. And that's because oftentimes when they push for something, they do tend to get their way. They don't just take a $4 billion stake in a company and push for changes and then kind of are expected to walk away and see what happens. As we saw with Starbucks, which traditionally Elliott hasn't gone after too many consumer names. That seems to be changing with Starbucks and now Pepsi. At Starbucks, though, they were effective in, seeing some change management at the C-suite, at the CEO level. That's not something that they're calling for publicly at this point in time. However, this is something that Elliott hasn't shied away from if they believe it's necessary to achieve the change that they want in a company.
Got it. And Leslie, thank you for rolling with the punches with me. I was getting confused about my activism here today with the Kraft Heinz, as I'm saying, thinking through my brain as the words are coming out. So thank you for keeping me back on track.
Well, you said you were hungry, so there's a lot of food news.
I need some of those PepsiCo snacks. Thank you so much. I appreciate it very much. Thank you, Leslie. Thanks for keeping us straight. Now let's move on to Christina Partsinevelos. She's got a CNBC News update. Hey, Christina.
Hi, Courtney. The Border Patrol chief who spearheaded the immigration crackdown in Los Angeles earlier this summer will lead operations in Chicago sometime in the coming week. Sources tell NBC Gregory Bovino will head operations there this month. Sources also say Bovino coordinated a sweep called Operation Trojan Horse in Los Angeles, where patrol agents jumped out of a truck in a Home Depot parking lot to make arrests. The EPA can cancel $16 billion in climate change grants. In a 2-to-1 ruling today, a federal appeals court ruled to overturn a lower court decision that required the Trump administration to continue funding the grants to help lower greenhouse gas emissions. The panel said the judge didn't have the jurisdiction to hear the case. And Lee Corso's final appearance on ESPN's College Game Day over the weekend set a ratings record for the show. According to preliminary Nielsen ratings, ESPN hit a record 5.1 million during the last 15 minutes of the show when Corso put on the Buckeyes headgear to make his pick of who will win the game between Ohio State and Texas. How fitting this is the last story for you, Courtney, because I feel like you have an opinion about
I mean, was there ever a contest?
I know.
OH, all the way. Thank you, Christina.
Thanks.
Well, coming up, Klarna is just one of 5 companies unveiling their plans to go public today. Is the IPO market ready to see that kind of action again? That's coming up next. Welcome back. 5 companies launching IPO roadshows this morning, including Klarna, the buy now, pay later company planning to offer a little more than 34 million shares, priced between $35 and $37 each, valuing the company nearly $14 billion. This would be the company's second attempt at an IPO this year after delaying plans following April's tariff announcements. My next guest says the IPO market is getting ready to meet its moment of truth. Joining me now is Dan Primack. He's the business editor at Axios. Dan, what do you think? The market is more receptive this time around, even if valuations have changed over time for Klarna, huh?
Yeah, look, I think the markets have actually been receptive for a while. I think you've had companies that have been a little scared to go out. You know, even if you look last year when there were relatively few IPOs, the ones that went generally performed well. The ones that went earlier this year, you know, there was that stoppage after the tariff announcement, the Liberation Day thing, including Klarna. But a lot of the other companies that had been planning to go public back in April ultimately did and have mostly been successful. But as you said, 5 companies launched their roadshows this morning. Traditionally, you do get this big boost after Labor Day. And I think kind of the excuses are going away for these companies.
Is this sort of the breakout from the holdback that we saw? I mean, is this, like you said, sometimes this does happen in a seasonality environment, but under this administration, we thought we were going to see deals and deals everywhere with loosened regulations. We haven't had it.
No, we haven't. I think what you're going to see is you're going to see this really steady stream for the next 2 months or 2.5, right? It's kind of the Labor Day to Thanksgiving push. We're not going to get what we had, 4 years ago with hundreds of companies going public, but we should be getting, 5, 6 a week starting next week when these companies on the roadshow actually begin to price. That's what everybody's expecting. And there is this incredibly deep pipeline. You've got companies like Klarna, which are these venture capital backed unicorn companies. Private equity has a ton. And there's some closely held ones also that are just sitting around. There's a lot of companies that should be going public right now. And as I said, I think the excuses have gone away. You've got near record high equity prices, despite some things that have happened in the market. You've got not tariff certainty, but kind of for a lot of these companies, worst case scenario, you get what we had last week, which were the Trump tariffs. Best case, the tariffs come off completely. And then you obviously have the Fed signaling that it's going to cut rates.
And so when you're looking ahead, what types of companies, sectors, or company specific do you think we can look forward to for those that don't cover the market as closely as you do?
I mean, tech is the big one, right? And if you want to put Klarna into that, I mean, it's a fintech company,
Sure.
Buy now, pay later, but it's essentially a tech company. Tech is where most of these are going to come from because that's where the huge backup is, because that's what raised so much money in the private markets.
Absolutely. We'll see what we get for the coming year ahead. I guess we got 3 months left to go in this actual year. Dan Primack, thank you so much for joining us to talk about the IPO pipeline ahead as we wait for Klarna. Well, coming up with key dates and data on deck, the dovish Fed President Trump is calling for could come sooner than later. We look at the potential takeover timeline. That's coming up next. Welcome back. As investors await a judge's ruling on the attempted firing of Fed Governor Lisa Cook, there are a few dates and data points that could bring about that dovish Fed that President Trump wants. So Steve Leisman has the story with us. What are you looking at?
There are very high stakes here, Courtney, for this judge's ruling. For President Trump, replacing Cook would give him a majority on the board, but it may also be the only way for him to gain that majority until the very end of his presidency. Right now, there are 4, call them non-Trump appointees, depending upon how you judge Fed Chair Jay Powell, Vice Chair Jefferson, Governors Barr and Cook, 3 Trump appointees, Bowman, Waller, and Myron, who has been nominated. This would be true through January of 2028 if Cook stays, and also if Powell decides to serve out the remainder of his term as Fed governor that ends in 2028. January 2028. But that would shift to 4-3 if Cook is removed and replaced by the president. You would have 3 non-Trump appointees, 4 Trump appointees. It would switch. The importance of this could be magnified in March when the Board of Governors votes on whether to reappoint the 12 district bank presidents. That happens every 5 years, including March of 2026. So the president will have this cudgel over bank presidents up until their reappointment. Whether this could matter depends on whether bank presidents vote on their jobs or based on their economic judgment, which they normally do. It would also matter how the judge in the Cook case defines what is sufficient cause for removal, helping determine just how much authority a president has over board members and their firings. Board members may not, of course, automatically give the president the low rates he desires. So Fed funds, they're trading dovishly, Courtney, but they have only added about a quarter point since this whole Cook affair began. It was already sort of on the dovish side. Now they're a little bit more dovish, and it's not like nothing else has happened in the meantime.
What's the current thinking about Chairman Powell and if he would stay through that 2028 term?
It's a good
January
question.
2028.
It's a good question. I mean, normally, traditionally, a Fed chair leaves office when his term as chair expires. He has the concurrent term as a governor. But if the Fed looks like it's put it this way, not in the shape that he would hope, he could stay to try to keep the balance the way he thinks it ought to be. So he does have a little authority. And of course, Courtney, there are a couple dates coming up.
Yes.
Well, first of all, one date, 8:30 tomorrow morning on Squawk Backs, I'll be talking to Fed Governor Chris Waller.
Okay.
That's important. And if there's a second here, I'd just like to show you the chart of, forget the other stuff I talked about. What about the data?
Yeah.
What about the data? Well, we have obviously ADP coming this week. We have the jobs number coming this week, 75,000 roughly, with a tick up in the unemployment rate, a big revision to jobs September 9th. And there's those 2 CPIs, all of this on the road to September 16th. And that will ultimately determine both what the Fed does that meeting, but also a bit about the economic outlook and how they position themselves.
Interesting. I feel like you need to do one of those balances, right? And you put some data here, some here, and you see which way we're tipping each day with each.
Do you have that
date.
scale that tells you the right answer?
But let's find it. You're going to be the one that's going to make it. Thank you, Steve.
Thanks.
Well, coming up, a record 17 million people went through TSA checkpoints this Labor Day weekend. Were you one of them? That doesn't necessarily mean a strong fall season, though, for the airlines. That's next. Welcome back to the Exchange. Airline stocks lowered today despite a record-breaking holiday weekend. Phil LeBeau joins me with what's next for the carriers now that the summer travel season is over. Hi, Phil.
Hi, Courtney. And it was a stronger season than many were expecting back in the spring. Remember everybody wringing their hands saying, oh, no, the traveler is pulling back. There won't be as many people taking trips. That didn't really happen this summer. We are entering the slow part of the year for the airlines between Labor Day and Halloween. Then it starts to pick up again at Thanksgiving. So what can you expect this fall? Well, capacity will be trimmed, not by a lot, but more judiciously by some of the carriers who had excess capacity. And we've known this was coming, by the way. Airfares are moderating. And the focus right now, low fare seats. For some time, it's been known in the industry there are too many low fare seats, chasing too few customers who are willing to say, yeah, I'm willing to go with this particular airline or that one. One airline stock that is up more than 13% today, Frontier. Take a look at shares of ULCC. They're adding 20 routes. Last week, we talked to Barry Biffle, CEO of Frontier, and he talked about adding those seats, targeting routes that are primarily where Spirit is. Spirit Airlines, by the way, has declared bankruptcy. That happened late on Friday afternoon. Once again, going into Chapter 11, going to restructure again. Big question is going to be what they do with their pilot contracts. That's one expense that the company will likely see if they can lower in bankruptcy as they go through their restructuring. Finally, take a look at American, Alaska, Delta, and United. Why are we showing you guys? We're seeing, Courtney, the haves and the have-nots within the airline industry. In fact, I talked to one executive who said, look, it's the airlines who are making a profit by targeting the premium customers, whether it's through lounges, seating, products, whatever it might be. We've talked about people being willing to pay up. And then you've got the rest of the industry, which is moving in that direction, but they don't have near the firepower that these guys have. So as a result, that's going to be a focus over the last half of this year. All of those airlines shares are down. But if you look at them over the last 3 months, Courtney, they've had a pretty nice move higher.
Interesting stuff. Phil, thank you so much. Everyone, book your tickets now for those holidays. Our next guest says strong travel and leisure data boosted a handful of stocks across the industry this summer, but there is one category outperforming the rest. Joining me now to discuss is David Katz. He's gaming, lodging, and leisure analyst at Jefferies. David, thanks so much for being here. We know you don't cover airlines, but you can talk to us about gaming, about hotels, about theme parks. So I guess let's start with the hotel. So we started with Phil. Let's say you get to where you're going and you're looking to book a room. What should we be expecting for room rates when you're talking about revenue per available room at a hotel or an Airbnb? And how do those trends either diverge or converge?
Yeah, the answer to almost all questions is it depends, and that applies here as well, which is if you look across the hotel pricing data, what you're seeing is that the luxury end is the only one that is still in positive territory in terms of pushing price higher. Right, pushing RevPAR higher and productivity higher. All of the other segments that we've seen are actually down. And in the month of July, per the note we put out late last week, you saw luxury was up 0.8%, which is not what I would consider to be a big up. And I think what the takeaway is that patrons, whether it's business or leisure travelers, are starting to push back on price within hotels, right? We've had just amazing price growth over the past couple of years. And I think the data is telling you that we're starting to see it push back. And one other important point is that the inbound international travel has been weak. I think many overlook the fact that Canada is the most important inbound international market into the U.S., and that has been down materially for a number of months now, whereas many of the international markets are still seeing some really meaningful growth. In fact, corporate near-term intent in the U.S. was down 5 percentage points, whereas corporate travel, near-term consumer travel was down 5 percentage points in intent, whereas corporate travel is still flattish.
And then what about cruise lines? I mean, these trends just really seem to amaze me. They just continue to be very strong. Are your expectations that will continue going into the rest of this year?
Love them, Courtney. And the reality is there's some things going on in the cruise industry after following it for many years that I think are very positive. Number one, I think the management teams across the 4 public companies are very good. And I'm not sure that you would have said that 5 years, 10 years ago. and the sophistication with which they are enacting change within the industry in how they book, how they engage with customers, technology, just overall execution is super impressive. The second thing is that from a Caribbean perspective, very important in the U.S., the launch of private islands. I experienced one myself a few weeks back with Royal Caribbean. It's an experience that is driving big-time consumer demand. There's something on these islands for just about everyone. And, the third thing about cruise is that it's still, as a value proposition, 20% less expensive than a commensurate land-based vacation. And so in this environment where we talk about prices meeting resistance, cruise lines offer this all-inclusive or mostly all-inclusive value proposition that's very compelling, Courtney.
That is very interesting, and I'd love to see one of those private islands. I hope I get there myself. David, I know you have a lot of coverage, but that's all we have time for today, so you'll have to come back another time to talk about the rest of the space. David Katz of Jefferies, appreciate you being here with us. Well, coming up, we have touched on recent pre-IPO valuations earlier, but we also get another eye-popping fundraising round from Gen AI giant. Those numbers coming up next. Welcome back. Anthropic announcing a new fundraising round today at a blockbuster valuation. Mackenzie Sagalas has all the new details in today's Tech Check. What do you know, Mac?
Hey, Courtney. So the company closed a $13 billion round that tripled its valuation to $183 billion. And at the same time that Anthropic is closing this round, you've got OpenAI that's going out to current and former employees this week with a secondary share sale that pegs its value at $500 billion. Now, both have been going head-to-head this year to capture enterprise customers. Anthropic's new Series F showing that its annual revenue run rate jumped fivefold since January to $5 billion. While OpenAI, at the same time, is ramping up its push for business customers with the launch of GPT-5, a rapidly expanding sales team, and pricing designed to undercut Anthropic. But the rush for capital underscores just how fiercely competitive this space has become. Labs pushing out products perhaps before they're fully polished, accepting that flaws will surface as millions of people begin using them, in part because so far that strategy has not dented valuations. Anthropic did settle a major lawsuit last week to clear a legal overhang, but the bigger risk for both companies may be reputational, how users interact with these systems as the companies adjust the guardrails. And unlike the last generation of tech firms that leaned on Section 230's liability shield, AI companies face product liability exposure if things go wrong, even as they continue to move fast and break things.
Yeah, I was sort of wondering that, Mackenzie. Every time you have sort of an issue, how does the valuation get dented, or does it not? Is it just sort of, this is a speed bump of how these things go?
Well, that's exactly it. A lot of investors have just been digesting that and moving forward. But we saw in the last week, OpenAI really make this big push to update the latest model to in the wake of a lawsuit that was related to self-harm issues. And that really reflects the fact that they are responding to these critiques and looking to adjust accordingly. But to the larger point here, you've got names like Apple and Meta looking to potentially embed the models from OpenAI and from Google with their Gemini product as they look to, enhance Apple Intelligence, or, Meta was looking at incorporating these base models to adjust its chatbot. So certainly there's a lot of cross-pollination here.
Interesting stuff. Obviously, this just continues to morph. Every day there's a new headline. Thank you for following it for us, Mackenzie Sagalas in San Francisco. Well, thank you for watching the exchange. Markets are lower here across the board. The Dow definitely off the lows of the day, down about 0.75%, I should say. S&P 500 is down, as well as the NASDAQ Composite, which is the laggard of the bunch. Power Lunch starts right now.
Markets and your money kicking off the week with a whimper as big technology leads the way lower. Welcome to Power Lunch, everybody. I am Brian Sullivan. The NASDAQ working on a rare back-to-back loss of more than 1%. All this as an appeals court rules that Trump's tariffs are illegal. And this as we enter the worst month of the year for stocks. Other than that, how is the play? Welcome, everybody. We got a lot to get to in the markets today. In this sell-off, here's a quick nugget for you. The NASDAQ 100 is trading below its 50-day moving average for the first time since April 30th. We had, remember all that tariff turmoil in early to mid-April, and the markets kind of came down 20% before rocketing higher. Well, we are back below that 50-day DMA. Let's talk about it, all of it. Here on set with us to kick things off is Citigroup's Director of U.S. Equity Strategy, Drew Pettit. Drew, it's very good timing to have you on today.
They're all important days, right?
They are. I mean, listen, and I don't want to make too much. 1% down Friday, a little over 1% down today. Markets still up nicely on the year. Nobody's panicking. No markets in turmoil yet, Drew. I know you're disappointed in that. But what are you telling clients about the markets today and what's going on?
Look, it's a healthy reset. I think we do have to step back a little bit and remember stocks don't just go up and to the right without a pause. In sentiment, I've heard other people talk about, sentiment's beaten up a little bit. No, it's coming off a really high level. So a reset there. Again, healthy expectations for growth, still up and to the right. So, take this opportunity.
Is today, again, we're talking about 2 days, so don't want to make too much of it. But if we had to ascribe a reason, is it markets were too hot? Markets were this? Is it the tariff ruled illegal headline? Is it something else? What do you think's going on?
I think it's a reaction to rates. So we can stretch this out a little bit. Yeah, tariffs, good for revenue, good for debt. Those coming off, you start seeing the 30-year moving higher, 10-year moving higher. Markets were priced for perfection, good growth, lower rates, all good for equity valuations. So it's just a bit of a pause. So I think, again, it's sentiment coming off of really high levels when everything was getting priced to perfection.
So, and again, this tariff ruling from the appeals court Friday, I was hosting Fast Money, was after the bell, hard to know what to make of it. Clearly, it will be appealed to the Supreme Court. We don't know which way they're going to go. I'm not asking you to make a legal ruling on where this goes, Drew, don't worry. But if the Supreme Court agrees that tariffs are illegal, in other words, they're gone, there are no tariffs, will we see continued moves in the bond market?
Probably, but what we might get, and here's the positive, is we'll get better earnings expectations. So here's the good and the bad. Bond market, rates higher, okay, bad for equity valuations, but tariffs going away is better for earnings expectations and margins. We think that wins out in the long run. So if it goes away, fundamental positive, market positive.
Yeah, you're talking about, let's say, pharmaceuticals, okay, as a group. And there's been tariffs on big pharma from Europe. China holds a lot of keys to some of the critical elements going to pharmas. Either way, pharmaceuticals, biotechs, they are impacted by tariffs. If that risk goes away, I would imagine that group could get a boost.
Yeah, I think it definitely is one area that's been in the crosshairs. But remember, those aren't necessarily IEEPA tariffs. That could be Section 232. So kind of more to come on which tariffs could stay and which ones can go. But not a lot of price into pharma. So any good news or alleviation of bad news could be good for the group.
Is there any, outside of tariffs, whatever, is there any group or groups right now that still look attractive relative to others or relative to the macro markets?
Yeah, it's funny. AI, always an important
Are you saying
topic.
AI?
I think so. I feel like we can't talk about markets without talking about AI.
Don't worry, we don't.
Oh, yeah. But the key there is that's a secular trend. But I think outside of AI, there are some really interesting value areas of the market. Some of the fintech names that fall into
Isn't that AI?
value. Even outside of the AI names, more of the traditional finance names that are finally delivering more of their products and services via tech platforms.
The firms of the world?
I would even say something like a BlackRock, a Capital One.
Oh, you're going all the way private equity.
Look, you can finally start to see that creep into more and more portfolios, and there's a margin expansion opportunity there. Equifax, again, tied to the mortgage market, but finally getting more of the credit reports and all of that history being delivered electronically.
Yeah.
I think there's a lot of opportunity there in financials plus tech.
Are there, so BlackRock is obviously, we talked to Larry Fink a couple months ago in Pittsburgh. There's all this optimism that, in your 401k, Citigroup and Comcast / Versant and NBC Universal, we're going to be able to buy shares of some of these private equity firms now in our 401k. I got to imagine, again, a gigantic lift to that group.
It is, and how do you deliver that? It's through better technology, not just for the funds themselves, but for the trading and liquidity ecosystem of something like private equity.
Is there anything that you don't like that's not looking good, that the valuation is still too stretched?
It's funny, we've been on this all year, cybersecurity. Everyone thinks it is this top line, persistent grower. Everyone needs it, but we don't see operating leverage there. When we think about growth themes, AI has it. Even the growth side of fintech has it. It's operating leverage. To us, we're looking for companies that can grow the bottom line faster than the top line. Cybersecurity as a whole doesn't really have it.
But if you look at the CyberArk deal getting bought by Palo Alto, you have to say, well, there's some kind of deal put underneath that floor, right?
That's fair, but on the other side, you also have headline risk when you have a data leak or a breach somewhere. So again, it's hard to invest.
CrowdStrike, yep, what?
But it's hard to invest as a cybersecurity company and then turn on the operating leverage button. You have to keep investing because new technology means new threats.
Your point, I think, is incredibly important because there's a lot of people that have bought into this group of cybersecurity, right? I don't know about you. I get some kind of scam thing weekly now at home, some credit card charge I didn't authorize. It's become a full-time job. It's annoying AF, as the kids may say. I'll say this. To your point, if you get a headline about some huge breach like we had with CrowdStrike a couple months ago, not picking on them, there'll be others, stocks fall. And then you got months to come back if companies come back at all, right? I think that's what you're talking about as far as headline risk.
Yeah, and again, back to if I'm priced to perfection, if I'm priced for a lot of growth, I want to make sure that growth drops to the bottom line. That's where other themes, even something like digital leisure.
What is digital leisure? Keep it clean, by the way.
Streaming, your viewers streaming this online now. It's not just linear cable, but even
CNBC Plus. It's a great value, by the way.
There you go. Even thinking about gaming online, like a DraftKings, for example. I think there are a lot more areas where tech is permeating that has operating leverage and a secular trend. That's where we want to buy when we're buying growth.
Roblox. You have kids?
Yep.
It's real money. Real money put into Robux, and it can be a lot of real money.
Yeah, and another one of our picks on our thematic 30 recommended list
is Roblox.
Yep.
I had no idea.
Yep.
I just threw that out there. I may or may not have kids.
I know they're what's atrophying my brain at home.
No, it is. But guess what? It maybe some of that money you spend on Roblox could be made up by buying the equity. It sounds like in your thematic 30, make some of that money back, right?
I hope, because daycare's not cheap.
No, nothing is, by the way. Drew Pettit, really glad you're here. Some great names, great ideas. Thank you so much. I appreciate that. All right. Equities, not the only class moving today. As we kind of just talked about, the big market story, maybe what's happening around the world in bonds, because they're all shifting at the same time. Don't believe us? Take a look at this. 30-year bonds in England, now at their highest interest rate since 1998. France, at its highest yield since 2009. And Germany also on the move. Prices down. Yields on the 30-year Bund, the highest since July of 2011. Kind of all makes you wonder, what is going on? Let's answer that question with Andy Brenner, head of international fixed income at National Alliance. He puts out must-read market commentary, and he joins us now. Andy, it's great to have you back on the program. It's been too long. What is happening with global fixed income markets?
Brian, it's a new month, and what you have is a lot of supply coming. You have supply coming all throughout Europe, and you have supply today in the corporate markets. We counted about 25 deals today, probably somewhere around 27, 28 billion, and that all has to be absorbed. Then, of course, as you mentioned with your last guest, you have the tariff issue. You take away the tariff income, and then all of a sudden you wonder, how is the government going to pay off some of this deficit? And that's a little bit of a concern. And then, of course, you have what we've been talking about more recently is, the Fed and will they continue to have their independence? And the less independence they have, the more the yield curve is going to steepen. So you've got all these things going. We said on Thursday, after all the month-end allocations and extensions with 10 years at 420, there was no upside. And now, you hit 430 today, and you're bouncing between 428 and 430. Similar with long bonds. You got to 487. You got to 499.6 today. You didn't quite get to that 5%. I think we're going to look at higher long rates. But one thing I will say is when you have the employment number on Friday, that could be a real barn burner one way or the other. If it's a much higher number than expected, we're going to see the CTAs get stopped out. We're going to see people get
What does
short.
that mean? I know what you mean about CTAs getting stuck out, but for the folks in the back, what did you just say? What does that mean?
CTAs are long 10-year futures. They're going to be forced to sell, as well as vigilantes will be coming in. There's going to be a huge force. Now, that's if it's a good number, meaning a number 100, 150 with 75 expected right now. And then if you get a terrible number, what it means is the Fed is absolutely going to ease in September, which we think anyway. The question then becomes, do they do 25 or 50? We still think 25. And the yield curve is going to steepen dramatically.
So this is an important point. And if I'm hearing you right, Andy, and I love reading your notes, that's why I'm so glad you came on. There's this expectation, and I don't blame people. The Fed cuts rates, borrowing costs go down. I don't think that's always the case. And is there an argument to be made that even if we get the 25 or the 50 basis point cut September 17th, that the bond market doesn't react? Or maybe the bond market reacts the other way, sells off the price, brings the yield higher because now it's worried about inflation or something else. Is that a possibility?
Brian, very good point, because 1 year ago when the Fed eased 50 basis points, it wasn't too long after that, the 10-year backed up 89 basis points. So you had the Fed cutting 50 and the 10-year backing up almost 90 basis points. So yeah, that absolutely could happen. And that's going to be a problem. But you know what? Basant's a very smart guy. He understands this, whether he has to cut back on the long end or something like that, if he doesn't like the results. He certainly hasn't added to the long end. We don't think there's going to be an operation twist. But, there was also an article that came out yesterday saying that the president wants to put in some kind of emergency procedures to help the housing market. Now, I'm not sure how he's going to do it. I'm not sure how he's going to get mortgages, which are around 6.5, 6.6, down to 5.5, which I think is what you need to clear out things. I'm not sure he's technically going to do that without getting the 10-year down in yield.
You'd have to buy mortgages, right, Andy? I mean, you just have to step in and become another Fannie Mae or Freddie Mac, I guess. I don't know.
Well, given that you have Mr. Pulte, both the chairman of Fannie and Freddie, anything could happen, but I still think he's limited as to what he can do.
Yeah, I think it's an important point, and it's well said. And your point about this Friday's jobs number is well taken. A really good number could see those CTAs get stopped out, and we'll see what happens. Andy Brenner of National Alliance. Andy, always love having you on. Thank you very much.
Brian, great seeing you again. Stay well.
All right, you too. Thank you. All right, we've got a news alert on ChatGPT parent OpenAI. Mackenzie Sagalos, what's going on?
Hey there, Brian. So OpenAI just made one of its biggest purchases yet, paying $1.1 billion in an all-equity purchase for StatSig, according to a source close to the deal. Now, this is a software startup best known for A/B testing and product experimentation with a customer list that includes Microsoft. Now, the deal stands out in an industry defined lately by acqui-hires like Meta with Scale AI or Google with Windsurf, where in practice it's really only the talent changing hands. But this time, OpenAI is buying the entire company, raising questions about whether rivals will keep using StatSig now that it's in-house. Its founder, Vijay Raji, will become OpenAI's Chief Technology Officer of Applications, reporting to Fiji Simo, who he overlapped with at Meta. He'll oversee product engineering for ChatGPT. Now, at the same time, we are seeing a wider leadership reshuffle across the company, Brian. OpenAI telling me that the deal and position changes are about building out its enterprise offerings and shipping those products faster.
All right, so I've just while you were talking, I briefly scanned StatSig's website, so I'm going to give you my 30-second expert view. So I'm a real pro, Mac, in this. It looks like StatSig as a company takes a lot of data and then tries to come up with some kind of logical outcome. In other words, it's a thinking machine in some ways. My best guess is maybe OpenAI is making this because OpenAI is filled with data. It's all they got, billions and billions of data points every day. And the key for anybody is to just make sense and have some conclusion from all that outcome and all that data. Yeah. No?
I know that is a strong read of what the company does, and it's really on the product experimentation side where it proves that utility, which is key here. Because think about what OpenAI has been pushing to do in the last few months with GPT. Well, in the last month with GPT-5, they're going after the enterprise customer, which has really been Anthropic's bread and butter, catering to that B2B consumer. And what they're looking to do is bring more products to market faster, and so this really helps to expedite that process. And it comes as, just today, Brian, Anthropic announcing that they closed their Series F. They've tripled their valuation. You've got OpenAI going out to employees just this week at a valuation of $500 billion. So there's a lot of money at stake.
Maybe it's just buying the ice cream cone so the other guy that you just mentioned can't have the ice cream. Either way, another deal, OpenAI spending some of that money. Mackenzie Sagalos, appreciate it. Thank you. All right, we are just getting started on a tough day for stocks and your money. Coming up, the big tariff twist that is confusing investors, but could actually be good news for some big name companies. Plus, small caps, big gains. Why Jeff Kilbert thinks that the smaller guys, they could be due for a bounce. Plus, the consumer crunch. What restaurants are doing now to try to win you back.
The first woman you killed was Karen Hodella.
RosenCo.com.
All right, welcome back. We've got a flurry of headlines that you need to know about right now. After the market closed on Friday, a federal appeals court said that Trump's tariffs are illegal, at least the ones related to national security. This will no doubt go to the Supreme Court for a final ruling. It is possible, maybe not probable, but possible, that all of the tariffs we've been talking about for 6+ months are ruled mostly invalid. Also, Congress back at work today following a 6-week summer break. And speaking of Congress, the Senate Banking Committee will hold a hearing tomorrow for confirmation on Stephen Mirren to fill the open seat on the Fed this Thursday, with the full chamber vote likely occurring the following week. Oh, by the way, Trump is also trying to fire another member of the Fed, Lisa Cook, but she is suing and saying that she is not going anywhere. Let's talk about it all with Chris Krueger, TD Cowen Managing Director, Washington Research Group strategist, and maybe the only man I know that can quote the Grateful Dead and Vladimir Lenin in the same piece, because you quoted Lenin, who said there are decades where nothing happens, and then there are weeks where decades happens. The latter certainly feels like that's what's happening right now.
Absolutely. I mean, it was 51 weeks ago was the Trump-Harris debate. So, I mean, it's pretty much every week. It's been nonstop for the past year. But when you think about what's coming this month, Brian, it's really monetary policy and trade policy. The only thing we've got some certainty on really was from July. We do have some tax certainty with the one beautiful bill being passed into law. But other than that, it's still very much wide open.
Yeah, and we can't know what the Supreme Court will do around these tariffs related to emergency acts. So clarify that, right? It's not all the tariffs. It's the tariffs that are related to what they call IEEPA, sort of the Emergency Powers Act. Those are the ones that are at risk. Let's just say, for giggles, Chris, that the Supreme Court agrees with the appeals court, because, by the way, we don't know what they're going to do, and those tariffs go away. What happens?
Uncle Sam's probably going to have to write a very large check. That's a problem because the bond market vigilantes have essentially become tariff men and women now. So you're talking about the potential for massive rebates. Through IEEPA, the U.S. has taken in a little less than $100 billion so far. The administration has until October 14th to file an appeal with the Supreme Court. The tariffs will remain in place until then. The Supreme Court may not rule on this until, next summer. So a tremendous amount of uncertainty. While that occurs, though, the administration has the 232 statute, has the 301 statute. That's what they've been using for sectoral tariffs and for largely the ex-fentanyl China tariffs. So those are not being litigated in this. There are two other statutes that, the administration, if they want to start sort of doing some of the work on this to prepare for a potential Supreme Court striking down IEEPA, they have 122, they have 338. Then you can essentially just put those reciprocal tariffs back on. The issue is really twofold, though. One, it's the potential for refunds. But then number two, that's the bigger issue, which is that all of these businesses across the globe will kind of remain in tariff limbo.
Let's put the pieces together because it is confusing. By the way, it's confusing on this side of the camera. I can't imagine how confusing it is for people who don't do this for a living. But what I think you said, Chris, is that these IEEPA tariffs, they are bringing in money. We can debate how much it is, but they are bringing in money. The bond market is moving today here and around the world based on expectations of less money coming in. Bond market may be negatively impacting stocks. So if these tariffs, the illegality of the tariffs is upheld, the bond market may move and we may end up with higher interest rates.
Absolutely. And also, don't forget last month, S&P kept the U.S., kept our credit rating largely due to the increased tariff revenue. The credit raters saying that increased tariff revenue would negate any of the negative fiscal from the $3.4 trillion one big beautiful bill. So it's there are a lot of irons in the fire. It's just sort of, it's just one more week.
But if the tariffs are ruled illegal, again, we're guessing. We have no idea what the Supreme Court, if it's even appealed to the Supreme Court, if they take it, by the way. If they uphold the appeals court ruling, there are probably a lot of companies out there, like Caterpillar's of the world, which warned on Friday about tariffs, that'll be celebrating, right? Like portions of the stock market are going to move higher, and portions of the stock and bond market will move lower based on the ultimate tariff ruling. Fair or foul?
In the short term, fair. I think what we would say longer term, though, is that if IEEPA is struck down, there are a number of existing statutes where the Congress has passed laws giving the President of the United States tariff power. That's sort of one of the main issues with IEEPA, is that the word tariff isn't in that law that was passed by the Congress. But when you look at some of the other statutes that are available, we do see tariffs returning. The real question is this uncertainty and this the potential for the U.S. to have to refund and potentially hundreds of billions of dollars. Keep in mind, though, the 50% steel, aluminum, and copper tariffs hold. The 25% global auto tariffs hold. We're expecting lumber tariffs, pharma tariffs, and semi-tariffs any day now.
How are you keeping track of all this, Chris? How do you do it? I mean, do you sleep?
Lots of good music, and hopefully my kids are watching right now. They go back to school tomorrow. But hi, Clementine. Hi, Clark.
Yeah, Clementine and Clark, your dad's doing great work. And thank goodness for you and your team, Chris, because I'm only able to understand it because I read your stuff. So make me sound smarter, and I appreciate it.
Well, we've got a great team at TD Cowen and Washington Research Group, and we listen. We watch every day for you too. So you help us break it down as well.
Much love to the entire overworked team. All right, thank you, Chris. All right, up next, why your market navigator thinks bigger is not necessarily better when it comes to investing in the months ahead. Jeff Kilburg, up with that next.